Feel free to post in the chat box. Feel free to unmute yourself and speak. What is your understanding of business valuation? Mitakshi says determining the worth of the business. Shri says the economic value of a business. Okay. Shri, please direct your messages to everyone. Economic value and worth of a business. What else do you know about business valuation? Have you ever done any valuation in the past? Anything that you know, any method you know, any agenda you know for doing the valuation, whatever you know. The evaluation of the business prospects. Okay. I worked on DCA, which is finding the current value of the company using future cash flow. Yes, that is right. Okay. So valuation is basically a process which is helps in arriving at the economic value of a business. And when we say the business, we mean the entire ownership of the business. And sometimes we might not be interested in the entire business. Sometimes we might be interested only in the particular part. So a valuation is a process of arriving at the economic value of a business or an ownership interest therein. That means, or a particular portion of a business. We might not be interested in valuing the entire parent company or the holding group, maybe a subsidiary, maybe a 30% stake of a subsidiary. It could be like that. Okay. And it is very subjective to the process you follow, to the methodology you follow, and to the assumptions you make. Because if 5 people are doing the valuation of the same company, they might come with 5 different results. But valuation is, a lot of people say it is an art. It is not only a science that it will always result in a specific answer. It is an art, and it is very subjective to the data availability. Because as and when you learn more about the business, you are able to better value it. And interestingly, the valuation also changes with nothing changing, just the valuation date. If I'm valuing the business today versus I'm valuing the business 6 months later, the value might change. The business remains the same, their products remain the same, everything remains the same, but still there can be a change. And there is a term VD stands for valuation date. Okay, so valuation is very subjective to the assumptions you make. Now, why do people do valuation? They might do it for a lot of reasons. Some people might do it for transaction purposes. For example, if they want to acquire a business, they want to do and undergo any merger or a joint venture, they need to know the value of the business to ascertain what price they should pay. Then there can be certain opinions, for example, in terms of the compliance, like there is a 409A valuation that is done wherein the businesses have to do it on a recurring basis as per the US laws. Then there is a gift and estate tax planning. Whenever a business is being transferred from the one generation to another generation, the government might charge some taxes on the gift and estate. So on that basis, also for that purposes, also the valuation is done. Now there can be certain legal requirements. For example, a business is filing for bankruptcy, then there would be a need for valuation. So there are a lot of reasons to do valuation. Sometimes people might just do it to evaluate any opportunity, and sometimes the business might do their own valuation just to understand how are they generating wealth for themselves, for the shareholders, not for any transaction, just to keep a check on how they are progressing as they are moving ahead in the timeline of the business. So there can be a lot of reasons and a lot of perspectives of doing the valuation. Okay. Now there are certain terms that you should be aware of. One is a PPA. PPA stands for purchase price allocation. Now, purchase price allocation means that if you are buying this business for, let's say, 1 CR, 1 crore. Now, this is the value of the entire business. And this is the purchase price that you are paying to buy this business. Now you need to allocate this price to different assets. If there are a lot of assets, for example, what value you will give to the computers, what value you will give to the machinery, what value you are paying as goodwill, and within goodwill, what are the customers that you are paying for their loyalty. So all of these are the methodologies or a process that you follow to allocate the purchase price. That is called purchase price allocation. And there is a whole full-fledged study or I would say subject knowledge that is required to do this. Now there is another report that is prepared is called fairness opinion. Now let's take an example that Vinita bought a company from Manoj. Okay. And Vinita is a company, Manoj is a company. So Vinita bought Manoj's company. Okay. Now there are 10 shareholders in Vinita's company. Now they need to understand that this acquisition is wise decision. And it will be called a wise decision when there's value, as in there should be a benefit that these shareholders should get. Now, Vinita must have done as an organization some due diligence to understand if this is a good acquisition or not, and then only would have acquired that business. But the shareholders might need a third party opinion. Like in case of accountancy, what happens? There is a firm that does the bookkeeping and all that stuff, and then there is a firm that does audit just to give an opinion. Similar is the case with fairness opinion. This is an opinion that is given by the valuation advisory firms with that the valuation is done in the correct method. There are no loopholes. The processes that are followed are logical. So it is a fairness opinion that is prepared based on the data that is provided just to give an opinion that the valuation is fair. There is no manipulation. So this is generally another type of report that is prepared. Okay. Now, do you know ESOP's employee stock option plan? This is the basically a perquisite that the companies provide to its employees as a motivation for their hard work that they are doing. There is another term called management sweat equity. There is a difference. So management sweat equity is basically there you are giving equity, you're not giving options. You are giving them a stake and it is only given to the management. In employee stock options, you are giving to all the employees, irrespective of them being the top management or the exact workforce. And there is an option. They have an option to convert that into a equity or not. Again, why, how, when do they convert or when they don't convert? We'll talk about that in the options class. But the point here is that you should know what is exactly an ESOP. It is a additional benefit given by any organization that is non-monetary benefit for the time being, but can be converted into a lot of gains when the company's value increases over time. Okay, I'll take a pause here. You can read this and let me know if you have any questions. Okay. Now, since we are talking about valuation, there are a lot of different definitions of value, the utility of a business. So we'll talk about a lot of them and then we will deep dive into many things. Just before that, I'm sure you guys must have heard about DCF. Can I have a yes or no? Have you heard about DCF? Everyone in the chat box, please. Yes or no? Sabil, yes. Tavleen, yes. Vinita, yes. Tanisha, yes. Dheeraj, yes. Manoj, yes. Ranjan, yes. Ankita, no. Shri, no. Okay. Ruben, yes. Idakshi, yes. Shrutika, no. Okay. 3 no's. Have you heard about any other method apart from DCF? Okay, Chris. Any other method to do business valuation apart from DCF? Okay, Sabil. Vinita comparables. Okay. So we have two answers. Sabil and Vinita. What else? DCF. Yes. Okay, Chris. Any other method apart from DCF? No, Mitakshi. Okay. No, Tanisha. No, Tavleen. No, Shri. Okay. Okay. Hey, Ishan, after a long time. Yes, Chris, relative valuation. This is the same as what Vinita is saying, comparables. Okay. Okay, so majority of you know DCF and majority of you don't know anything apart from DCF. Okay. Okay, let's come back to the discussion. That was helpful. We'll talk about value. So we'll talk about a lot of methods related to it. One of them is fair market value. Then it is fair value. Then it is investment value. Then it is intrinsic value. Okay. Then we will talk about equity value and enterprise value. Then pre-money valuation, post-money valuation. All of these are the different types of values. Okay. So whenever applied as a rule, whenever you hear the word market value, it has something to do with the demand supply. It is a basic economics that whenever you hear something related to the market, it means that there are market forces and market forces are demand and supply. So fair market value is the value that the market recognizes. Whatever is the share price in the market, it is that fair market value. It is decided by the market. You and me cannot decide. We can influence as investors based on the shareholding we have, but we cannot decide what is going to be the price of the share or the company. So this is based on the market forces, and it is a general conception that is followed that market is intelligent enough to accommodate all the available information, all the publicly available information. Okay. Now next comes the fair value. Again, this is a value that is fair, but there is a new thing that gets added is the legal part. So this is supported by an agreement. It is honored through a legal construct. Okay. And it is not only based on the market sentiments. It is supported through a legal construct. So whenever there is an angle of a legal, then it is called fair value. Okay, now investment value. So the company's value could be anything based on its fundamentals, based on anything. Investment value is basically what the investor is willing to invest. The company's shares might be trading at, let's say, $100. But I, as an investor, believe that it should be $110 and I'm ready to pay for it. I'm ready to pay $90. This is what I, as an investor, is ready to pay. It is obviously done through a mathematics of the fair value, but it can be very different from the fair value based on my risk assessment of the company. Then comes the intrinsic value. So intrinsic value is the value which you arrive at using the future cash flows discounted to the present value. Sounds something similar to DCF? Yes, it is. So intrinsic value is the name of the value based on the method of DCF, or if you don't want to call it DCF because it is very specific to cash flows, it could be anything, discounting the benefit, the future, discounting the future benefit to the present value at an appropriate discount rate, and that value you get is termed as intrinsic value. So these are the different versions of value that you should be aware of. Okay, Tavleen, but I don't have any pending. If you can send me again. In fact, I would recommend. So, Tavleen is asking about a LinkedIn connect. So, I would recommend that you all should also connect. It's a good way to network. Awesome. Now, let's talk something that you are going to use more frequently in business valuation. So, think of this as a company, okay? We are talking about equity value and enterprise value. See, both are EV, but whenever we say EV, we actually mean the enterprise value. So always remember that EV is an abbreviation of enterprise value and never an abbreviation of equity value. That's the first thing. Secondly, whenever you are running a or company, there might be different sources of capital. Some could be the equity shares that you would issue. Some portion would be the preference shares. Then you might have something coming from the minority interest, something coming from the loans, and etc. Okay. So this portion, the first brick, it is called the equity value. And everything combined, I'm calling it net debt for now. Everything combined is called enterprise value. So when you are investing in the ownership of a business that is represented through equity only, it is an equity value. But when you are considering the entire value of the business, including its liabilities and ownership, it is called enterprise value. So the equation that gets created is the enterprise value is equal to equity value plus preferred stock plus minority interest plus net debt, okay, plus any other like any unfunded pensions or any other major liabilities that is existing in your business that you are using for your current running of the business. So all of that. This is the equation. Now, equity value, sometimes if it is a public company, it could be called the market cap. It's called market capitalization. And it could be calculated as the number of shares outstanding multiplied by the price per share. Okay. And the net debt is basically your total debt minus cash and cash equivalents. So these were the facts. Now let's understand the logics. So first we need to understand what is the difference between equity and enterprise. We understand in terms of the formula. So equity value is restricted to the ownership of the business. Enterprise value is the value of the entire business, including the ownership and the liabilities assumed. It represents the total capital, not only the capital contributed by the owners or the shareholders, but everyone who has invested in the business in different forms. It represents enterprise value. Okay, so whenever you are acquiring any business, you will be doing a enterprise value valuation. But when you are investing in the shares, you would be concerned about the equity valuation. Okay, now equity and preference. This is very easy to understand. Equity is basically that portion of the capital which represents the ownership. It has the voting rights. The equity of a public company trades on the stock exchange, and for private, it does not. Preferred are basically which hold priority over equity when it comes to declaration of dividends. Equity holders do not have any compulsion to receive the dividend, but preferred have a fixed dividend percentage that they would receive, but they don't have any voting rights. Okay. Equity people are also called the residual owners of the business. Now the point is minority interest. This might be something new for a lot of people here. So let's talk about that. Minority interest. This is also called non-controlling interest. So let's say there is a company Alpha. Okay. And there is company Beta. They both have invested in the business Gamma. Okay. Company Alpha owns 80% stake and company Beta owns 20% stake in Gamma. So Gamma will be the subsidiary company and this will be the parent company. Now, since Alpha holds the majority stake, majority means more than 50% of the stake, Alpha is the majority owner of this business and holds a controlling stake. Controlling because since it's hold major stake, it can influence the decisions. The voting power lies more with the Alpha. So it has a control over its decisions. And same reason, Beta is called non-controlling or minority stake. So here Beta is minority. But how does this impact enterprise value? This is okay from the concept. Now, as per the reporting standards, the performance of Gamma, it would be combined with the performance of Alpha and shown in the books of accounts of Alpha. For example, if Alpha makes a profit of let's say 1,000 and Gamma makes a profit of 100, so it would be shown like the profit of Alpha, profit of Gamma, and the total profit is 1,100. So this would be shown in the books of accounts of Alpha. But technically, Alpha does not own the entire 100. It owns only 80% of 100. So then there would be a negative component that would say that this is the net profit attributed to the non-controlling stake. That would be 20. and you will get to the number of 1080 as the net. So this would be shown, the portion that is attributed to the non-controlling, it would be shown as a separate mathematics as an adjustment to arrive at the value in terms of the parent company's actual combined with the subsidiaries stake, the stake that it has in the subsidiary. So this is how the mathematics goes on. This is something you will see in the Colgate model case study as well. Once you complete it, it has this adjustment. So if you are unable to do, we will do it in the class. But this adjustment or this logic is applied there as well. Any questions on minority interest? Okay. Now, you can quickly skip through this page. Dheeraj, okay. Let's read this, then we'll talk again. Okay, let's resume. So there are broadly three different approaches to do the business valuation. One is called an income approach, one is called market approach, and one is called cost approach. Income approach has two methods. One is DCF, that majority of you already know, and is very widely used in the industry. Okay. The next one is capitalized earning method. In market, we have two methods. Market approach is also called relative valuation. We have trading comparables and transaction comparables. Comparables are also known by the short name COMPS. They are also known by the name of GPC, that is guideline public comparables, and GTM, guideline transaction multiples, or guideline public companies and guideline transaction multiples. GTM are also called precedent comps, and STM, that is select transaction multiples, or PTM, precedent transaction multiples. So these are a lot of names for these. The cost approach has one method that is called NAV, that stands for net asset value method. So these are the different methods that we will talk about between today and the next two sessions. So let's start with the income approach. So a lot of you said that you know DCF. May you unmute yourself and tell me what exactly is your understanding of DCF? Whatever you know, either you can post it in the chat box or either you can unmute yourself and speak. What do you understand by DCF? Money today has more value than future. Ranjan, that is not DCF, that is time value of money concept. That is TVM. The discounting the future cash flows onto the present value. Okay. What else?
So we estimate the future cash flows first. then discount them to the current date, and take a sum of all those future cash flows to determine the current value.
Okay. Okay. Chris says method used to determine the future cash flow and discount it to the current value. So what Tavleen said, what Vinita said, and what Chris said is the same thing. You first project the future cash flows, you discount it to the present value, and that is your valuation, or that is your DCF method. And the value would be called an intrinsic value. Anyone has a different answer to this? Apart from what Tavleen, Vinita, and Chris mentioned. Okay, Manoj. Okay. See, what they mentioned is perfectly fine. DCF is one of the methods to do the valuation on the income approach. If you are from a commerce background, in your college, you must have done a bond valuation, that's for sure, wherein the formula that your teachers or professors might have taught you would be something like that. You take the cash flow one, then you take the cash flow two. Let's say it is 3 years, then you can take the cash flow three and your terminal value, whatever is the uh, par value of your bond that you will get on the maturity, discounted for at a rate of interest at raised to the power 1, 1 plus r raised to the power 2, and 1 plus r raised to the power 3. And sum them up. The value you get is this of your bond. This is your intrinsic value. Let's say doing all this maths, you get the intrinsic value is 1000. If the bond is available at 1200, you should not buy it. It is overvalued. But if the bond is available at 900, you should buy it. This is the basic mathematics that has been taught to you in your college. Everyone agrees with this? This is what is bond valuation, wherein what you are doing. This is an explanation for the income approach. I'm not talking about DCF right now. I'm talking about income approach, the broader umbrella, wherein you identify what is the benefit that you would be getting in the future, and you bring that value of the benefit to today by discounting it, because the value of the money today is very different from the value of the money 5 years later. Okay. So you bring those cash flows to the value today, and then you say that this is worth 1000 in today's value, in today's money power. Okay. And if this is same thing is available in the market at 1200, then I will not buy it because it is worth 1000. Why will I pay 200 extra? It is overvalued. But if it is available in the market at 900, you will buy it because it is then undervalued. It is a good value stock, a good growth opportunity to invest. Now, if we talk about DCF or capitalized earning method, they are based on the same premise. Here, the benefit that you are getting is the cash flow that you are going to consider. And here, the benefit that you are going to consider in the numerator is the earnings, the net final profit. DCF, so you know that there is a accounting principle by the which states that the business is going to run for a foreseeable future. There is no intentions to close down the business or trim down the operations, the going concern assumptions. There is no end period as of today as for the business. Business is assumed to run till infinity theoretically. That is a going concern assumption. Okay, that is used in DCF, but that is not used in capitalized earning method. So capitalized earning method, there are specific timelines of a project that you are evaluating. For example, if I invest, what should be the worth of the project of a, let's say, a flyover that I'm building, then it will take these many years. This would be the cash flow that would be generated. So I will get to the worth of that business. So it is a definite life project. So that is a capitalized earning method, wherein then you are basically calculating the net present value. You are just ascertaining what is the NPV that you will generate out of this project. But DCF is a way more detailed and way more scientific. In DCF, you are basically going to discount the benefit of the future benefits to present. This is the basic theory. But the benefit here is cash flow. And it is the cash flow that is available to the capital contributors. It is not the cash flow that the business generates. The business might be generating $1,000 of cash, but it might be paying out something to its capex or to working capital, and then might be left only with $400 of cash. So it is the free cash flow that you use. So free cash flow is basically the cash that is free from any working capital or capital expenditure obligations of a business, and it is freely available for the capital contributors, for the owners, for the stakeholders of the business who have invested money. I'm not saying this money will be distributed to them. This is available to them. Availability and distribution is different. You might have 10,000 in your bank account that is available. It does not mean you will withdraw everything today. So that is your available money that you have. You might not withdraw, but that is going to be the metric that we will use to value the business using DCF. Okay. Now, let's talk more about free cash flow. But before that, you can just have a quick read here. Okay. So when we talk more about free cash flow, as I mentioned, free cash flow is going to be the metric that resembles what is the cash that is the business has generated and is available for capital contributors after meeting all the working capital and capital expenditure obligations of the business to run it. Now, first thing that you need to focus is free. That means after meeting all the obligations. And cash. Cash means that we are not talking about profit. We are talking about the actual money that the business has generated. So if the company sold everything on credit, it has zero cash generation. So you need to understand it is not based on the profit, it is based on the actual hardcore cash that has the business been generating. Now, there are different ways of arriving at the free cash flows, and there are two different versions of free cash flow. One is free cash flow to the firm, and one is free cash flow to the equity. So when we say free cash flow to the firm, we mean that we are talking about the cash for all the capital contributors. And when we say free cash flow to the equity, this is the cash that is available only for the equity contributors. So when we have free cash flow to the firm that we arrived from the business, we will subtract the debt payments, and then whatever is the money left, it will be the money for the free cash flow to the equity, because equity will be paid only and only after the external liabilities obligations have been met. And external liability obligations means the loans, the debt. So equity is paid last. That is the risk the equity contributors have, and that's why they are called the residual owners of the business. So this is a relationship between free cash flow to the firm and free cash flow to the equity. I repeat, both are the cash flows that are free for the business obligations and available for capital, but the definition of capital changes. Here it is all the capital contributors, and here it is only the equity contributors. So after meeting the debt obligations. Okay. And when we say debt obligations, I mean both interest and principal. Okay. Now, how to calculate the free cash flow to the firm? Because if we know how to calculate free cash flow to the firm, we can easily get to the free cash flow to the equity. So we will talk about how to calculate free cash flow to the firm. One of the easiest way is cash flow from operations minus capex. This is one of the quickest way to arrive at the free cash flow to the firm number. Cash flow from operations would mean what the company is generating the business after all the working capital obligations, as in whatever the company is spending in terms of the salaries and all that stuff. And then for business capex obligations, we are subtracting it. So this is one way of getting to the free cash flow to the firm. Then there is another method that's a bit long that we will talk about. You start with EBITDA. Okay. Then you subtract DNA, you get to EBIT. Then you charge tax on it. You get to no PAT. That is called net operating profit after tax. Then you add back DNA because it is a non-cash expense. Then you subtract the changes in working capital, you subtract the capital expenditure, and any other changes in asset and liability if you want to. This way you get to the free cash flow to the firm. This is the second method that you can follow. The third method could be you start with net income. You add back the interest 1 minus T, that is the tax adjusted interest. This way you will be able to reach here. Okay. Then you do the same thing. You add back DNA, you subtract changes in working capital, you subtract capex, and there could be a possibility. DNA, don't understand it as a single line item, understand it as a representation of the non-cash expenses. So you should add back any non-cash expense that you made, and you should subtract any non-cash gains that you made. And this way you will be able to get to the free cash flow to the firm. Any questions? This is the first step to do your project, to do your DCF valuation, to calculate the free cash flow to the firm. Again, now one more thing that you should know is the free cash flow to the firm. It is also called unlevered free cash flow. And free cash flow to the equity, it is called levered free cash flow. So whenever you hear the term levered or unlevered, you should remember it's something related to debt. So levered means the impact of debt is captured here. So obviously the impact of debt is captured. That's why it is only representing the equity. So it is levered. Here, there is nothing that's called an impact of debt that is captured. So hence it is unlevered free cash flow. Okay. Give it a read and tell me if you have any questions. Hi everyone, good morning. Good morning, Mitakshi. Good morning, Shrutika. Good morning, Tavleen. Good morning, Swati. You all can see my screen, right? Good morning, Anjali. Good morning, Ankita. You have good energy after the Republic Day. Awesome. So in the previous session, we had initiated the discussion on the valuation, and this is our second session in the series of valuation. So we discussed the different types of values: fair value, intrinsic value, investment value, equity value, enterprise value. We discussed the relationship between the enterprise value and equity value. Why do we take net debt? Why is cash subtracted? We discussed about the leverage, operating and financial leverage. We also discussed about the unlevered, levered, free cash flow to the firm, free cash flow to the equity, and how are they calculated. Any question anyone wants to ask from the previous session? Okay. So I'll just give you a recap of the three approaches that is part of our discussion as a part of this module. So we have income approach, we have market approach, and we have cost approach. Income approach, we have two methods. We discussed DCF and capitalized earning method. In market, we have the trading comps or GPC, GTM, the transaction comps, and the market is also known by the name of relative valuation. And in cost, we have NAV. So we had discussed the brief overview of the difference between the DCF and capitalized earning, and we had initiated the discussion on the DCF. Okay, so we discussed about the calculation of free cash flow. I'll show you two practical examples of how to calculate the free cash flow and how are they further used. So as you know that there is a accounting principle by the name of going concern assumption that is the premise for our valuation in DCF. Can anyone quickly tell me what do you understand by the going concern assumption or going concern principle of accountancy? that the company can continue in the foreseeable future. Okay, can. We hope to run the business for long-term perspective. Okay. See, the intent is right, but exact, I would say, literature or the concept is that the company does not have any plans to close or significantly reduce the business operations in the foreseeable future. So it is not can, it is it will. It is expected to continue as is in the future. It might expand, but it does not have any plans to trim down the business significantly or shut down its operations. Now, if that is the case, if we are saying that we are going to value the business based on the present value of the future cash flows discounted at a discount rate, this is what DCF is. That the valuation would be this present value. We are going to take the future cash flows and bring them to today. Then if it is a going concern assumptions, we need to take for infinity, like why are we stopping at 3 years, 5 years, or 10 years? What is the period after that? Because the business will exist. So there is a new concept called terminal value. Okay, anyone knows what is the terminal value? Have you heard about terminal value? Estimated value of a business. No, Raja. This is not right. Estimated value of business cannot be terminal value. That's some different characteristic. Something else. Value at the end of the term. Okay. Anyone wants to take a different shot? For particular time period. Particular time period. Okay. See, you understand now that there are three things here. First, the business is going to exist for a foreseeable future. It's not going to stop working after 3 years, 5 years, 10 years, or 20 years. It is going to run for infinity, for example. Now, if that is the scenario and we are doing the valuation using DCF, we have to calculate the future cash flows so that we can bring them to the present value using a discount rate. For that, we will need cash flows for all the periods, and all here stands for infinity. So we cannot have lot and lot of free cash flow. So what we do as a practice is generally we forecast the individual periods like 3 to 5 years. So if we are, let's say, sitting here on 31st December 2023, for example, so we'll do it for 2024, 25, 26, 27, 28. So these periods we will discretely forecast, and everything after the period of 2028, like 1st Jan 29 till infinity, it will be captured into terminal value. So terminal value is basically a consolidated version of all the value that you are going to generate from the business after the discretely or individually forecasted years. So everything that is after these 5 years is captured or is packaged into the terminal value. And terminal value is calculated using three different methods. Okay. So why do we calculate terminal value? Because we cannot individually forecast. The business does not have that much clarity. You can sense the business sentiments, you can sense the economy sentiments for next 3 to 5 years. You cannot say what will happen after 10 years. That would be too vague of an assumption. So you need to take some like overall assumptions, high level assumptions. For that, you need terminal value to be done. Any questions, anyone? Now, there were a lot of people in the last class who said we know DCF. Can anyone tell me how to calculate the terminal value? I'm 99% of you will not be able to tell all the three. Anyone wants to take a shot? You have 2 minutes only. No one? At least one or max two. You can try. Two of them are very common. Everyone who studied DCF should know those. Okay. One is correct, Vinita. Hey, time's up. So the three methods are Gordon growth model, H model, and exit multiple. Now, all the three methods have different premise. The Gordon growth model and H model believe that the business is going to run for future and the business owner does not have any plans to sell the business. And this exit multiple, exit means that you are taking a exit from the business, you are going to sell it. So exit multiple is based on the premise that if the business is sold after 5 years, what is the value that I will get of the business from that sale. Again, now if we talk about Gordon growth and H model, so Gordon growth model is basically based on the premise that the business after these 5 years it will grow at a fixed rate. That is also called perpetuity rate. So some people called Gordon growth model as perpetuity growth rate. Now, H model says it is not possible. Like, for example, if your business is growing at 50%, then 40%, then 60, then 70, then 40, then you cannot expect it to grow at 5% or 4% flat. There might be some transition period. So H model gives you two rate of growth rates. One is a transition period that for a few years, that is a short term period, it will grow at let's say 20%, and after that it will grow at 5%. So that is to bridge the high growth and the stabilized growth rates. And hence it is called H model. And this is called H, that is the period, the transition period. So H model is generally used for those type of companies which have very high growth in the individually forecasted years, and the perpetuity growth is way too less to stabilize immediately or suddenly. Otherwise, the most preferred ones are Gordon growth and exit. And it is a damn fact that the valuation that you will get using the H model will be higher, because for a few years you are growing the business at a higher growth rate when compared to Gordon growth, and that will lead to more valuation. So if you are preparing a model and using both the methods and you're getting a value that is less in the case of H model, then you are doing something wrong. It is a factual check. Okay. So H model valuation will be always higher than Gordon growth. There is no relationship, or I would say no concrete relationship that you can identify between exit multiple and these two. It might be high, it might be equal, it might be low, it could be anything. Any questions on the overview? Then we will go into formulas and stuff. Okay. Before I tell you the formulas, you need to understand that whenever you are doing DCF valuation, as the name is discounted cash flow, this is the cash that is available. Told you in the first session as well. This is not the cash that is distributed. That will be the dividend or withdrawals. But this is the cash that is available. So this tells you what the business has the ability to offer to the capital contributors. Now you know that there are two types of values that you can calculate for a business. One is enterprise value and one is equity value. Now, if you are doing the valuation using free cash flow to the firm, that is your unlevered free cash flows, you will be directly jumping to the enterprise value. Then you can go to equity value by subtracting net debt, subtracting minority, subtracting preferred debt and preferred shares, equity, and etc. But if you have to directly go to equity value without any of these adjustments, you can use free cash flow to the equity, because that would be the cash flow that is available only to the equity contributors. Now, if your numerators have changed, then your denominator should also be in parity. So for a free cash flow to the firm, the discount rate is WACC. And for free cash flow to the equity, the discount rate is cost of equity. You need to remember this always. And if you have calculated the equity value using free cash flow to the equity, you can again go to enterprise value by adding the net debt, adding the preferred, adding the minority. But you need to make sure that if you are doing the calculations using free cash flow to the firm, the discount rate will be WACC. If you are doing it using free cash flow to the equity, the discount rate will be cost of equity. Do not mix the two. The numerator and denominator should be in parity. This is a very, very important point. And the interviewer might confuse you. Hey, I want to calculate equity value. Can you do that using free cash flow to the firm? So answer is yes, I can do it. I can calculate the free cash flow to the firm. I can discount it using WACC. Then I can adjust it for the net debt and everything. I can directly get there. Or if you want not to use it, you can do it using free cash flow to the equity. But for that, you will need cost of equity for discounting. So this is the comprehensive answer that you need to know. There is less of theory here and a lot of concepts and logics. So let me know if you get stuck anywhere and we can rediscuss it. Okay. Now let's go to the formula. For now, let's assume we are calculating enterprise value using free cash flow to the firm. Okay. So as per the Gordon growth model, the terminal value is basically the last forecasted years free cash flow to the firm. So let's say it is nth period. So free cash flow to the firm for the nth period, that is the last forecasted year, multiplied by 1 plus G. And G is going to be the perpetuity growth rate. That is going to be the terminal growth rate, or it is going to be the Gordon growth rate. It could be called anything. Divided by WACC. That is going to be the discount rate, because we are using free cash flow minus G. Again, the G is same. Now you need to make sure that you cannot randomly take any growth rate, because this is going to be the growth rate till infinity. And if you take such a big number, the business might outshine the global economy. So ideally, the growth rate should be less than the GDP of a country and more than the inflation. This is a logic that you can live by. Then you can adjust it based on as you develop more understanding of the business. Because if you take something less than inflation, then you are not going to beat the company like prices versus the nation's economy's inflation. But if you're taking a growth rate that is higher than the GDP growth rate, then your company will become one day bigger than the country's GDP, which is not practically possible. Your company cannot have a value more than the GDP of a country, because it can be equal if everything else becomes zero mathematically, but it cannot be higher. Everything has to become negative then. It's not possible. Okay. So something between the GDP growth rate and inflation is okay. This is the formula. You can make a note of it. The H model also has a similar formula, but an extended version. So the first term is same. Free cash flow to the firm. T. Here there are two growth rates. So let's take G1, this, or let's take G2, because this is going to be the second growth rate, the long-term growth rate. Okay, divided by WACC minus G2. So this portion is same. Then you have another portion plus free cash flow of the firm for the last year, okay, multiplied by h by 2. H refers to the transition period. Some people write it like t by 2 also, divided by, again, WACC minus G2, and there is another term at the top. So you know that if you are using H model, these are the 5 periods discretely. Then there is, let's say, 4 period of transition and then infinity. So there would be different growth rates here. Then there will be a number, let's say it is 10%. Then this will be a number which will be lower than this. So your G1 is generally going to be higher. So it will be G1 minus G2. This is going to be the formula. So free cash flow of the last year multiplied by 1 plus G2. G2 is also called the long-term growth rate, and G1 is called short-term growth rate. H is the transition period. So here it is 4 by 2. This is H model formula. And it is generally used with those type of companies which you don't expect to come down in terms of the growth rate to a perpetuity one. You want a transition from a high growth rate to a mid one and then to a perpetuity growth rate. Then the next one is an exit multiple method. So exit multiple method is similar to your relative valuation that we will discuss the market approach. Here, as it says exit, the company is going to, the investor is going to take an exit from the company, and he is doing the valuation based on the multiples. So multiple could be of revenue, it could be of EBITDA, it could be of, let's say, free cash flow, it could be of gross profit, it could be of anything. Let's assume that there are two cases this. So what you are going to do is, let's say the multiple is 3x and it is 15x in this case. So you will take the revenue of the 5th year and multiply it with 3. So whatever is the revenue, it would be 3R. And you can take EBITDA of the last year, the last forecasted year, and multiply it by 15. Let's say you want to do it based on both. So if you take the values that you get from here, they might not be the same. You can take the average of the two and say that this is the blended number that I'm getting. This is the average number that I'm getting. And this way you can get the terminal value. Read this page, then I will show you practically how to do it. Done. Awesome. Okay. So once you have calculated the terminal value, it will be the value that is calculated as of the end of the 5th year. That is the last forecasted year. So you need to bring that to the present value. You will use the same discounting technique that you are going to use for the free cash flow to the 5th year. Now, what do I mean? I'll show you practically. See, so this is how we calculate the free cash flow first. So we have the revenue. Revenue has no relationship with EBITDA. It's just a summarized version that's being pulled from the financial statements. So you have the EBITDA, then you subtract the depreciation. You get EBIT. EBIT is called the operating income, right? Then you subtract the taxes. You get the NOPAT. That is the net operating profit after tax. Then you add back depreciation. You subtract the CapEx. You subtract the changes in working capital. You get to the free cash flow. This is clear. Show some energy. All clear till here? Everyone. All sorted till free cash flow? No one has any doubts still here. Everyone can build this. Awesome. Now, there are certain adjustments that are done that I'll tell you in 5 minutes. Then you get to the terminal value. So this is the Gordon growth method, right? So how are we going to use it? We are going to use the free cash flow for the last period multiplied by 1 plus G. So here the terminal growth rate is 2.5% divided by the WACC, that is 10% minus G, 2.5%. So we are going to take, I repeat, the free cash flow of the last period multiplied by 1 plus G divided by WACC minus G. Simple formula application. Then you have the terminal value. You can calculate the present value of the terminal value by multiplying the discount factor for the last period. Simple. This is done. Similarly, once you are doing it for H model, you take the last period free cash flow. Okay. Then you have all the assumptions that are written. You simply apply the formula and you are done. Here, exit multiple, we are taking it based on the EBITDA. So EBITDA, we have taken that it is going to be 13.4x. So we are going to take the last period's EBITDA, okay, and multiply it by 13.4x. This is the value that we are getting as an exit multiple. So these are the three different methods of calculating the terminal value. Any questions on whatever I told you? Not anything that you can see, only any questions on whatever I told you. Awesome. Now, there is a very basic fact and very confusing fact, or I would say very basic and silly error fact that you guys would do. DCF is done using only and only the future cash flows. You cannot use the past cash flows. And I can bet 70% of the people make this error that if the interviewer, if you are sitting in the interview and they give you a case study and they try to trick it, you get into the trap and you use the past cash flows. I have seen people doing a lot of this error. So whenever you are working on DC evaluation, you need to make sure that the cash flows that you are using are always of the future period. And when I say future, I do not mean that anything that is after today. For deciding whether it is a past or a future, you need to do it based on the valuation date. So if there is a valuation date of 31st December 2022, even 2023 year is also a future. Although if I see calendar today, 2023 year would be the last year, but if the valuation date is this, then 2023 is also future period. So technically for DCF, you actually don't need the past financial statements for valuation purposes. For projections and analysis, it's a different story. But for valuation, you only need the future. Am I making myself clear? Now, this is okay. But let's say that it is given that your 2023 financial statements, actual, you made a free cash flow to the firm of 150. In 2024, you are expected to make, or let's say, this is March ending company, okay? So 2023 actuals means March 31, 2023, okay? 2024 budget is, let's say, 200. 2025, you are expecting 250. And 2026, 300. What will be the cash flows that I will consider? Like, can anyone tell me the numbers, the four numbers that I will consider here? The valuation date is 31st December 2023 and the financial year ending is March 31. What is going to be the amount of the cash flows in the 4 years that I will consider? $200, $250 and $300. Okay. Ankita says $200, $250, $300. That means Ankita says this, this and this. Shrutika says $300. That means she says this. What else? If you want to unmute yourself and then speak, you are free to do that. But tell me what is the answer. So Tavleen also says 24, 25, 26. That means Tavleen, you are agreeing with Ankita's point? Those values? Okay, perfect. What else? We have 3 responses. Type in the chat box, unmute and speak, but tell me because this is very important. And I told you 70% will miss here. Anjali, what do you think? What is the answer? Chris says 200. You mean only this? Anjali says 24 to 26. Again, you agree with Ankita there and Tavleen then. Raja, what is your answer? Give yours and Vignesh combined answer. Dheeraj says 300. Dheeraj agrees with Shrutika. Okay. 200 to 50, 300, 200 to 50, 300. Okay. Vignesh, Raja agree with Tavleen, Anjali and Ankita. Okay. So we have the majority votes here. Anyone who disagree with them? Like anyone has a different answer? Because none of the answers is right. Everyone gave a wrong answer. Vinita, you want to take a shot?
I knew we won't take budgeted year, but I don't know the reason for it. So I did not type it out.
Okay, you don't know that. But you are saying you will take 250 and 300 license.
Yes, 25 and 26.
You are incorrect. But that's also a wrong answer. None of you gave the right answer. Ruben, you want to take a shot? Ishan, Chris, Tanisha. Strange, I told you just now. One more minute. Okay, let me tell the answer. See, the valuation date is 31st December 2023. So anything prior to that is waste of time for me. I will consider only the cash flows after that. And I will consider all the cash flows after that. So this is going to be the period that ended in 31st March 2023. And that's a date prior to this. So I'm going to consider nothing here. So it would be nil. I'll consider the zero. Now, this is 31st December 2023 and this is 2024. That means something after. Now, this is going to be the number 200 for the period ending 31st March 2024. That means from 1st April 2023 to 31st March 24. Agree? What portion of this is going to be the past? It is 9 by 12 is already gone. 3 by 12 is going to be the future. That means I will consider 1 by 4th of this. That is 50. For the entire year, if I have the quarterly numbers, the best. Consider the few fourth quarter numbers out of the future. But if I don't have any quarterly numbers, this is the best guess I can make is that 3 quarters have already passed. I'll not consider them. There is 1 quarter that will come after the valuation date of this fiscal year. I'll consider that 50. For this, I'll consider total. I'll consider total. So you need your valuation date will not always be the end of a fiscal year date. It can be anything randomly in between, and the year might be going on. So you will consider only the numbers or the proportionate numbers after the valuation date till the end of the first fiscal year, and after that you can consider full years. Clear to everyone now? 0, 50, 250, 300. Anyone has a question? And Vinita, there is no reason why not to consider budget. If it is a future, you consider it in DC. So you will consider the proportionate only. Okay. Perfect. Good. Now, here I could do the maths easily. That it is 1 quarter. Let's take 1 by 12 into 250. Simple. But if they are random dates, let's say the date is 17 September 2023. Then what will I do? I'll not do using a calculator what are the number of days that are in the future divided by 365 multiplied by number. Because the dates might change. I want something dynamic ability in my model. So there is an Excel function by the name of year frac. That is the year fraction. It asks for 2 inputs, start date and end date. So you give them a start date, you give them an end date, and they will tell you that the period between these 2 dates is how much portion of the entire year. So if I give the start date, here the start date will be the valuation date. That is 31st December 2023, and end date would be the fiscal year. It will give me the answer 0.25. That this is this period that you are giving between the start date and the end date, it is 25% of the entire fiscal year. Now see this. So once you have calculated the free cash flows, what is your valuation date? Valuation date is 17th December 2020. So this is a different model. Let me show you a different one. Yeah, this would be a good example. See, so the valuation date here is 31st July 2021, and the first forecast year is 31st December 2021. So you will ignore the first 7 months of the year and you will consider only 5 months of the year. That is 5 by 12. You agree with this? So for this, you calculated the free cash flows. The full year free cash flows is coming something around 105.8 in the first year. Then it is 123, then 136, 121, and so on. These second year onwards, second year is 1st December, 1st January 2022 till 31st December 2022. You will take the full year because that's an entire year is a future. But this is the running year, the current year. So you will take a portion of this. So what you will do is you will take year frac. You will add a year frac function. The start date would be the valuation date and end date would be the forecast year end date. The first forecast year. The answer comes as 0 point something. That is 5 by 12. You'll multiply it with the total year cash flow. For other years, it's going to be 1. You can easily check that. The answer is definitely going to be 1, but to have a formula, you can take the start date, end date, and they are both the extremes of the year. So it is going to give you the answer 1. So you multiply that for evenness in formula, and this is going to be the cash flows that you are going to consider in the numerator for the mathematics. Any questions till 41st row? Starting from here. Now I have a very important point to address. So you guys have heard every time in academic literature that whenever you are calculating any ratio or you are doing any analysis and you are taking a value from the balance sheet, you should take the average values. Everyone would have heard this from your teachers in the past, your professors, your colleagues, or your managers, that whenever you are taking a balance sheet item, you should take the average. And whenever you are taking income statement value, you can take directly the number. Agree? Everyone has heard this once in their accounting or finance careers? Yes, no? Okay, Mitakshi, others? Yes, Vinita, yes, Danisha. Yes, Dheeraj. Guys, wake up fast. Others, this is going to be an important discussion. Now tell me what is the reason? Why do we do this? We do it, okay, but why? What is the actual reason here? You can type in the chat box, you can unmute and speak. Tell me. No one knows the reason? Balance sheet value at a specific period and needs to be averaged out. But okay, that is okay. But why, Chris? Like, why average out? It is at a period, at a specific point. That is a fact that I agree. But why it needs to be averaged out? Because it is at a specific period. Like, what is the reason? Mm, to overcome any anomalies or fluctuations. Um, that's not the exact answer. But I don't know what you are thinking, so I cannot guarantee that you are looking into the right direction. But that's not the answer. Something different. Okay, let me give you a hint. I'll not give the answer directly. Let me give you a hint. So we are in 2023, for example. We have the financial statements ready for 2023. The opening balance, that would obviously be the balance of 2022, of a loan is 10,000. And the closing balance is 15,000. And you have to charge an interest of 10% per annum. What is going to be the interest value? Whosoever gives the answer, please unmute and tell me how you calculate it. This is the opening balance. This is the closing balance. The interest rate is 10% per annum. What is going to be my interest expense for fiscal year 2023? A very, very basic question. Guys, how is interest calculated? Chris says 2,500. What else is the answer? Guys, this is a basic question. How is interest calculated? Ankita says 1,500. Okay, Chris, how is 2,500 calculated? Can you unmute and tell?
I think actually revise that number. I've taken the total, but as opposed to the total, I think I'll take the final number to get 1,500.
Okay, so your answer is 1,500. That is 10% of 15,000.
Yes, so because I'm assuming at the beginning is 10, but then in between the period, there may have been maybe repayment and also maybe additional loan that came in, that is of the net effect of borrowing of 5,000. So, but since I'm not so sure at what point it came in, so I'll take the final figure and assume that was the interest that was charged. Because I think the other way would be, if I had specific dates, I would charge separately for the period that the loan is in existence.
Makes sense. Makes sense. I agree. Okay, Ankita, do you have any explanation, or is it simple 10% of 15,000? Simple. Anyone else? A different answer, a different reason? Dhanisha and Vignesh says 1250.
So, my reason for 1250 would be, so at the opening, whatever the opening balance, I took an interest calculation on at that point, and then closing balance, and I averaged it down. Since there has been a fluctuation, and we don't know at what point of time.
Okay, so okay, okay. Let's accept it. Vignesh, same reason or anything different? Okay, same reason. Anyone else has a different opinion? Well, I'm going to tell you something very important and interesting. So these are the only three possibilities, right? You cannot have any answer apart from these. So what Chris was making an error initially was he was adding this, but this is not an incremental value. This is a closing balance. So this already has this plus whatever happened in between. So it is 10,000 plus the net increase in the loan liability of 5, and then you get 50. Okay, so these are the three answers that you can possibly have. You cannot have any other fourth answer. Now, all the three answers are right, depending upon what is the scenario. We do not know when was the actual loan of 5,000. Let's assume it's simple. It was a 10,000 loan, then 5,000 was additionally raised, and now it is 15,000. We do not know when was this 5,000 loan taken. So will have to take some assumption. So if I go with this number, I am assuming that this additional 5,000 loan was taken on the last day of the year. That is why I assume that for the entire year, for the entire period, the 10,000 that was the opening balance was valid, and then the incremental value of 5,000 was taken on the last day. So there is no interest that is going to be charged. If I take 15,000, that means I am assuming that the incremental loan or the additional loan was taken on the first day of the year. So it is equally obliged to be charged an interest as the $10,000 is. So we, for the entire year, we were using 15,000 and we will be paying interest on the entire. Now, these two are okay to use, but these two are extreme conditions. Either you are assuming it was on the first day, or either you are assuming it was on the last day. What if I want to assume that it was on the mid? I can follow mid also. If I follow mid, then for first 6 months it was 10,000. Then for the next 6 months it was 15,000. Or I can say that it was 10,000 for the entire year and additional 5,000 for the second part of the year. Either way, we are talking the same thing. So then the interest will be 1,250. So this is considered one of the mediocre assumptions, and hence you take average in case of the balance sheet. This is called mid-year convention. And if I do this, this is called end year convention. I'm taking the last year value. Forget about end year. This is mid-year convention. You will get confused with the India. Okay. Now everyone understands that all the three are right, but they are based on different premise. Anyone has any question on this? Okay, Ankita. Others, question or a thumbs up? Okay, Vinita. Okay, Mitakshi. Okay, Dheeraj. Okay, Anjali. Tavleen, first of all, you should ask questions addressing to everyone. So Tavleen has a question, which one to use? If you are given the actual dates, then there is no problem. Ideally, I would recommend that theoretically or academically, you should use the average. Okay. But this creates a problem when you are doing it for the first year. Okay. Now, you need to understand that is there any movement of cash? Is there any other variable that you are using? If no, then average is the best one to be used because it is academically the correct one. Practically, you will do some manipulations. There is no harm saying that as financial modelers, you will do some number dressing so that you can get to your desired results. And that, see, it is very evident that every year the interest expense is different. And this is something you are doing when you don't have knowledge about the company or their model. But when you are actually working with a company, they will give you a term sheet. It will be written specifically when is the money coming into the picture, what is the period start date for the interest calculation and everything. So till the time you are not doing something that sensitive, you go with the mid-year. So Dhanisha and Tanisha, or Tavleen, sorry, the answer is mid-year, this one. Preferably. Others are also okay, but whatever you use, give a note. Now, I'll give you a very basic question and I want the answer. Everyone do it on Excel, pen and paper, whatever. There is a financial advisor who has visited your home. Okay, a financial advisor came to your home and said, "Hey man, I want you to invest in this particular bond." He tried to convince your parents, but you being the smart person in the room, you entered into the discussion. So the financial advisor was saying that you give me 15,000. What if the interest rate is floating? That doesn't matter, Chris. So interest rate is floating, the interest rate will change, interest expense will change, but the base, it won't change. No, it would be dependent. If you say that the interest rate becomes floating in the mid part of the year, like for 6 months you have to take a different interest rate, for 6 months you have different interest rate, then there is a difference in the amount as well. Getting the point, Chris? Okay. So let's continue with the example. So financial advisor has come to your home and is suggesting you to invest 15,000 in a particular bond. Okay. And if you have to invest 15,000 in a particular bond, he's saying that you will get 3,000 for 3 years, and at the maturity, you will get 15,000 as well. So this is going to be the interest that you will earn every 3 years, and at the end of the third year, you will get 15,000 back. Okay. Then there is another opportunity that you know that if you invest in a particular business, you will be able to earn 20% every year. This is your opportunity cost, and this has become your required rate of return. So this is the rate of return. If you get something more than this, you will invest. Otherwise, you have an option to earn 20%. Why will you invest in this particular bond? So the question is, will you invest in this bond or not? Tell me the answer. Raja says invest in bond, it is generating same interest rate with low risk compared to business. How is it generating same interest? Can you share your screen and show me the calculation? Or tell me how you did it? Unmute yourself and tell me, please. Tell me, like, if you can type, else anyone else has an answer? No one has an answer. Hmm. Anyone wants to take a guess on how we can do this? Even if not a perfect answer.
Maybe I could try. Tell me if the approach is that I'm thinking of is the right one. So look at the cash flows that is expected. That is 3,000. The initial amount being 15,000. Then I look at the cash flow that is expected. Then since you've given the 20% as the rate promised, guaranteed rate, so to speak, I use that one to discount for the cash flows. That is 3,000 year 2 and 3,000 in the year 3. I do now the total of 3,015 that I'm going to get. I get 18,000 in total for the three years.
Okay, so what value did you get then?
I think I got 18, a total of 18.
Okay, so then you will invest or you will not invest?
I think I will invest.
You will invest. Why?
If I look at the, well, I needed actually to have also discounted the other 20 for 15 to see, to compare the two. Give me a sec.
That's a good answer. This is interesting. I randomly took a number and it gives you the exact answer. Okay, so everyone here, please. So what you are doing is you are investing this amount. Okay, I'll just say 25 so that I get a different answer, or maybe 15 to get a different answer. Okay. So this is going to be the cash flow that the bond will generate and give it to you after every year. So at the end of the first year, you get 3,000. At the end of the second year, you get 3,000. And at the end of the third year, you again get 3,000 and the principal amount back. So in total, you are getting 3,000 after 1 year, 3,000 after 2 years, and 18,000 after 3 years. I'm just changing the percentage assumption. So the investment that you will make in a business guarantees you 15% annual return. So you will discount this and you will see what is the present value of these cash flows discounted to today at a 15% rate of interest. So 1 divided by 1 plus 15 raised to the power 1, 1 divided by 1 plus 15 raised to the power 2, and similarly for 3. Then you will multiply them and you will get the discounted value. You get to the total. So all these cash flows are going to be worth 16,712. If there is a package of income that is worth 16,712 at a discount rate based on your risk assessment, and you are getting that at 15,000, that means it is available at a cheaper cost. So you are going to pay 15,000 for something that is worth 16,700 today. Go for it. it's a good investment opportunity, go for it. So the intrinsic value is 16,700 and it is available at a value of 15,000 in the market. So it is undervalued. You should invest in this. So the answer is yes. But had it been 20%, you would have been indifferent. Had it been 25%, you will not invest because it is worth 13,500 and it is available at 15,000. So it is costly. You will not invest. Getting the point? Now, anyone has any doubt here? Energy clear? Good. Now, why did we do this example? We did this example to show that this is the cash flow that is generated at the last day of the year, and you are discounting it for the complete 1 year. It makes complete sense. Now, first important point in terms of theory that you need to know is this row. This is called discount factor, and this is called discount rate. So whenever you have a discount rate, that is 1 plus r, and you take it 1 divided by 1 plus r raised to the t, it becomes a discount factor that you will use with the corresponding values to get to the present values. Okay, so you need to understand there is a difference between a discount factor and a discount rate. Discount rate is this, discount factor is this entire calculation. Okay, now whenever you are going to raise to the power 1, that means you are discounting the entire number, assuming it is generated at the last day of the year, and you are discounting it for the full year. But that's not the ideal scenario in a business. So if you are given the free cash flow for year 1 is 1,000, you will not discount it for the 1 year completely, because this 1,000 would be generated over the year. Some money would be generated in the first day, some on the 10th day, some on the 20th day, some on the 50th day, some on the 100th day, and some on the 365 day. But you cannot discount it evenly for the, like, assuming that it is generated on the last day. That would be lowering, or that would be an extra burden on your valuation. So to conquer this, there is a concept that we will apply here for mid-year convention. So last 20-minute discussion was for this, that there is a mid-year convention concept that we'll apply here. But you need to first understand why do we apply, because we cannot apply a growth rate, or sorry, apply a discount rate raised to the power the complete year on something that is not generated on the last day but over the year. So because if we do it, we are going to put an extra burden on the valuation. You understand the reason of learning this? The reason is to not put an extra burden on this, because this cash flow is not generated only on the last day, it is generated over the period. But if you assume that is generated on the last day, it is called end year convention. But we will follow two. 90% of the industry follows end year convention because they are unaware of the mid year convention. But whoever is preparing a detailed and a most logical model, this is considered as an advanced technique of valuation. So what I recommend the people is to create a switch, create a drop down for the analyst to choose if he wants to go with the mid-year or end year, and give that functionality in your models. So if he selects end year, the methodology switches to end year, and if he selects mid-year, the mathematics changes accordingly. Now, what is the difference? So the numerator does not change. So in the entire mathematics, it is only the t that changes. So if I am doing mid-year convention, then obviously I will take 0.5 raised to, instead of 1, I'll take 1.5 and I'll take 2.5. Agree? So the average of, because year 0 to year 1, the midpoint is 1.5. Year 1 to year 2, midpoint is 1.5. Year 2 to 3, midpoint is 2.5. Everyone agrees? So instead of taking raised to the power 1 and 2 and 3, I will take 0.5, 1.5 and 2.5. Everyone agrees with this? I'm going to make it more difficult in the next 2 minutes. So you need to understand this. Okay, Tavleen. So what I am saying is, you understand that we have to do mid-year instead of end-year. You understand the reason, Tavleen? Okay. So you are doing valuation as of this date. This is first year. This is second year. What is the midpoint of this period? It is going to be 0.5. Then you are taking the cash flow for this period. The midpoint is going to be 1.5 from here. So you will discount it for 1.5. You will discount it for 0.5 to get it to the present. Right, Tabli? So instead of taking raised to the power 1 and raised to the power 2, raised to the power 3, you will take raised to the power 0.5, 1.5 and 2.5. Okay, Tabli? Got it. Now, this is conceptually. How will you do in Excel? Let's go back to the model now. Okay, so you are getting one since now the valuation date is 31st December 20. So I will be taking the full year of 2021. So the first adjustment that is done in terms of year frag, you're getting 1. So we are going to consider everything. The numerator is sorted. Now for the denominators raised to the power value, that is the time frame, you will take 0.5, 1.5, 2.5, 3.5, 4.5. Conceptually, we all know, but how are we going to do it practically? So whatever is the year frag, you will do it divided by 2. So for the first period, second period, third period, fourth period, fifth period. For the first period, it will be year frag divided by 2. So whatever is the start date and end date, you divide it by 2 and you get to the mid value of it. That's perfectly logical. Now, since you reach the mid value, you will multiply it by 2 to get to the end value. Now, the first period, it could be a full year, it could be a partial year. But the second period is definitely going to be the full year. Now, if you are doing multiplied by 2, you are reaching the last day of the first year. And for the second year midpoint, you have to travel only half. So you will add 0.5. Now, once you have reached the midpoint of the second year, every time the midpoint of every year, it would be the mid only because we are considering full, and they would be at a gap of 1 year. So +1, +1, +1. I know this is difficult and technical. I'll repeat everything again. Listen carefully. For getting to the midpoint of the first year, the valuation date and the start date, valuation date and the end of date of the first fiscal year can be anything. Like they could be a full year, they could be a half year, they could be a quarter, they could be anything. You have to take the midpoint of that. So you take the year frac and divide it by 2. So you reach the midpoint of the valuation date and end of the fiscal year. Now, as the next step, you take the previous period value multiplied by 2. You reach here. Then you know that after the first period, that is the second period, it is definitely going to be a full year. So full year's midpoint is 0.5. You add 0.5. You reached here. Now you know that every year after that is also a full year. And the midpoint of every year is at a gap of 1 year now. So +1, +1, +1. That is the logic. Now if we go to Excel and see it. So this is going to be year frac divided by 2. Okay, Then the next period is the previous period multiplied by 2 plus 0.5, then plus 1, plus 1, plus 1. Simple. This way, it can take any value and it will not get disturbed. So if I do it 21 and let's say October, it will automatically get updated. First, it will take 2 by 12, then it will be taking half of it. Then you multiply it by 2 plus 0.5 and plus 1, 1, 1, 1. And this will automatically be going into the raised to the power. This is how you calculate the discount factor based on the mid-year convention. I'll take a pause. Any questions? You saying something, Ankita?
Sir, I was asking that you were saying as raised to the power. Can you show in a mathematical format?
Yeah, says, you know. So you remember we took an example 3,000 cash flow, 3,000 cash flow, 3,000 and 5,000. So this
Yes.
we have to discount it, let's say at 15%. What we used to do? We used to do 1 divided by 1 plus R. Okay, and we used to freeze this raised to the power 1, and let's say I create 1 here. This is the formula that we used to do. Now I'm saying that we are not going to use this. We are going to use instead 0.5, 1.5 and 2.5 because we are going to do the mid-year convention. Now, if our start date, that is the valuation date, I mean the start date of our analysis changes, this will further change. And to make it dynamic, we are going to use year frag by 2 in the first period, then previous multiplied by 2 plus 0.5, then plus 1, plus 1, plus 1. So that is the raised to the power of this formula. So you remember this if you this T1 and T2 calculation we were doing. Okay, Ankita?
Yes, sir.
Perfect. Anyone else has a question? Now, a very important and small point, then we can take a break. So you have calculated the individual cash flows, you adjusted it for the time frame, you got this. This is going to be a new date. Then you took the year frag, the concept that we discussed. You calculated the discount factor 1 divided by 1 plus R. Here R is the WACC raised to the power of the time frame. Then you will multiply this with the cash flows and you will get the present value of the cash flows. This is going to be done for the first 5 years. Then you will sum them up. You'll calculate the sum of all the present value of cash flows, irrespective of whatever model you are using, Gordon growth, H or exit multiple. The present value of the individual cash flows is going to remain the same. Then terminal value we discussed. In the case of Gordon growth, we'll take the future cash, free cash flow of the last forecasted year, multiplied by 1 plus G divided by WACC minus G. Then H model, then exit multiple. Then this is going to be the value as of the 5th year. So we'll bring it to today. In the Gordon growth and H model, you are doing it based on the free cash flow. So your present value mathematics is very easy. You have the terminal value, you will multiply it based on the discount factor that is calculated for the last period. That is 0.64. Okay. So if you go here also, it is going to be this terminal value multiplied by 0.64. But this is not the case with exit multiple, because this 0.64 that we have here, it is the discount factor based on the premise of a free cash flow, and it is taking in the mid-year. And hence, if it is a mid-year, that is the midpoint, it is midpoint of 31st December 24 and 31st December 25. That is 30th June 2025. An exit multiple will assume that the exit will happen at the end only. It cannot happen something in between. It is at a point. So once all the future discretely projected periods are over, then only the exit will happen. So in this scenario, we will have to take an additional half year. We cannot take what is calculated there. We will have to take a discounting for additional half year. So when we have calculated terminal value, when we have to discount it, we will again create a formula. The formula would be 1 divided by 1 plus WACC raised to the power the period. And the period here that we have taken, we will add half year to it. Because this is the period, the adjusted period up till 30th June 2025. We will add another half year to reach the end of this year. And we will have a discount factor that would be created out of this discount rate. And that would be used to calculate the present value of the terminal value. Once you have the present value of the individual cash flows, you have the terminal value, you sum them up. And you see, H model gives you a higher value, and that is the case always. Okay. Now you can do sensitivity analysis based on the data table. So that's about the DCF calculation. What is remaining is how to calculate WACC. Let's take a break here. If you have any questions, you can post in the chat box. Right now it is 11:30. We'll keep it very quick. Let's connect at 11:40. Then we'll have a 20-minute discussion. Yes, Tableen, obviously. Or if you want to take a 5-7 minutes break and then do the 20-minute discussion and then end the session, we can do it that way. Do you want a 5-minute break or a 10 minutes break? Everyone in the chat box. 5, okay. So 11:35 we are resuming. It's 11:30, 11:35 we are resuming. Okay, let's resume. So as we discussed that for WACC, it is going to be the discount rate that we will use for discounting the future projected free cash flow to the firm. So WACC stands for weighted average cost of capital. The formula to calculate WACC is the weightage of equity multiplied by cost of equity plus weightage of preferred multiplied by cost of preferred. Okay, when I'm saying equity, I mean the common equity. Don't mean the total equity. Okay. Weightage of debt multiplied by cost of debt 1 minus T. So whenever you are taking cost of debt, you will take it net of taxes, because the cost, the service of the debt, that is the interest, it is a tax deductible expense. So you always get a benefit of taking a debt that the expenses are tax saviors. Because if you distribute dividends to the capital contributors, you will do it after paying the taxes to the government authorities. But the interest, they will help you save certain taxes. So hence it is taken 1 minus T. So this is weightage of equity, weightage of preferred, weightage of debt. And obviously, if there are only three capital contributors, the sum of them should be 100%. Then cost of equity, cost of preferred, cost of debt. Now, there is an entire discussion that we will do for these costs, but weightage is comparatively easy. So for weightage, you can do a lot of things. The first thing you can do is look at the company's financial statements, look at their balance sheet and see how are they positioned in terms of their capital, like what is the contribution of the debt and equity in their total capital. That is one way, but that is something that you will give you an overview of how they are positioned today, but not how are they positioned tomorrow. So ideally the capital structure that you have to use is going to be a target capital structure. So if the management thinks there is not going to be any material change, then you can use that. What another option that you have is you can look at the capital structure of the peers of the similar companies that are trading in the public stock exchanges. So you will look at how have they positioned their capital structure and you will take an average or a median of them. So that is going to be a proxy that is called GPC capital structure. You are taking the peers, public peers capital structure for your analysis as a industry, I would say, proxy, as a representative of the industry norm, because you are taking 10-12 peers, so that on an average represents the industry, the key peers. So these are the two methods that you can take. If you still want to take the debt and equity of your balance sheet only, you can take the book value or market value. But generally, the market value of debt won't be available, so you can go with the book value. You cannot take one thing, book one book, okay, because it distorts the mathematics. Okay. So these are a few things that you should keep in mind while taking the weightage. Okay. Any questions? Okay. So write down a question and give me the answer. The company's debt to equity ratio is 2:3. And the cost of equity is 15%. The tax rate is 30%. And cost of debt is 7%. What is the WACC? And for our discussion, we can for now assume there is only common stock and debt. There is no preferred here. Anyone answer? Ruben 11.5, Vinita 11. 22 is 2:3. Anyone else want to attempt it? Mm. 10.9. Vinita, one decimal answer what it is? Tavleen 13.27. Everyone have a different answer. Land 0. Okay. I'm sure you are messing up in weights. This is easy. Okay, so KD 1 minus T 4.9. This everyone is getting. Then the weightage of equity. It is 3 portion of the 5. So it is 3 by 5. And 2 portion of the 5 is debt. So 2 by 5. Now, if I multiply these two, and I add them, I'll get the answer. So 10.96 is the answer. Dhanisha, you got it? 10.96? Perfect. You are the star. Vinita, is it 10.96 with 2 decimal? Because 1 decimal would be rounded off to 11.0.
No, it's not.
Okay. Very strange, Chris. Okay, so cost of equity, cost of debt, this is easy. So weightage of equity. So debt to equity ratio is 2:3. That means for every 2 pieces of debt, there are 3 pieces of equity. That means total pieces are 5. So debt is 40% and equity is 60%. So 60% of 15%, 9%, 4% of 4.9%, 1.96. You add them, you get 10.96%. So this is the WAC. Anyone has any question on how we did this? Anything that is unclear? All is good? I have a problem. Yes, tell me, Ankita.
Sir, please explain this sum again.
Sorry?
Please explain this again.
Okay, so okay, you don't unmute yourself. I'll ask you a lot of questions. You just tell me. Let's say there are two classes, class A, class B. Okay. Class A has 10 students. This is the number of students. Class A has 10 and class B has 20 students. The average marks that the class A student got were 30 and average marks the class B student got were 40. The principal wants to know what is the average of the entire batch. How will you do that, Ankita? Ankita, you there? You're on mute. May you unmute and speak? I could not mute. You are already on mute. You have the rights to unmute. Anyways, do you know how will we calculate the average of the entire batch? I'm asking you, Ankita.
Sir, average is most only 35.
Sorry, what you're saying?
Average is 35. 35.
No. So here is the problem that what you are doing is a simple average. But there are 10 students who got 30 and 20 who got 40. So there are more students who got higher marks. So you will first calculate the total marks of class A, that is 300. Okay. Total marks is 800. Or into 2 8, you will total 1100. 1100 total students 30. 1100 by 30. So it would be 110 by 3. Let's assume 111. It would be easy to do the maths. So it would be 337 something. So your answer would be more inclined towards the bigger number because there are more students who got 40. So that this is called weighted average. If you take the simple average of the numbers, you are assuming that both are equally important in the maths. But actually, this has more importance because more students got high number. Similarly, what we are doing is we have cost of equity is this, cost of debt is this. We need to understand what is the contribution of equity and debt in the capital. So 60% because we know that debt to equity is 2:3. That means debt is 2 piece, equity is 3 pieces, and total pieces is 5. So debt is 20 and equity is 30. Or we can say 20 by 50, 30 by 50, or we can say 2 by 5, 3 by 5, or we can say 50% and 60%. So that is what we did, 60/40. Then you have, these are the weights. Now like we did the multiplication here, we are doing the multiplication here. Then we added, we are adding. We are not going to divide by anything because multiplication the weights a total 1,000,000%. That is 1. So divide is the same number. Had we done multiplied by 2 and 3, then we would have divided it by 5. But we're doing it in percentage, so no division is required.
Okay.
Okay. So there is another way of doing it. I'll show you if that makes it a bit easy. So let's say weight and cost. Cost of equity is 15%. It's easy. Cost of debt 1 minus T. We know it's 4.9%. Okay. Let's say weightage of equity, we are taking that equity is 3 pieces and debt is 2 pieces. Okay. Then we can multiply the. So now when we will sum these, we will divide it by the sum of the weights. That is going to be 5. Get the same answer. Got it, Ankita?
Okay, sir. I got it.
Okay, perfect.
Yes, sir.
Anyone else? Any questions? Okay, so in the next session, we will talk about the individual calculations of cost of debt, cost of equity, and cost of preferred. And then we will talk about the cost approach and the market approach. So that's it about today. We'll aim to complete the valuation piece tomorrow, and then you will be expected to work on the DCF valuation of Colgate in the Colgate model itself that you were preparing. And we will have a doubt session not on the next weekend, but on the weekend after that. So on the weekend of the 10th February around. Okay. So 14 days from now. Okay. And there won't be any sessions on the weekend of 3rd and 4th Feb. So tomorrow, and then there will be a gap so that you can complete your models in time, and then we will reconnect. Okay. Thank you. Have a great Saturday. See you tomorrow. With any doubts you have, go through the book, understand, go through the models, flip through the sheets. They are all available on Elements, and develop an understanding. Okay. Thank you and have a good Saturday. Bye-bye. Hi everyone. Good morning. Good morning, Ranjan. Okay, so we have been discussing about the business valuation. Good morning, Vignesh, and we'll continue discussing that. So yesterday we had an in-depth discussion about the DCF, how to calculate the terminal value, how to arrive at the enterprise value and equity value, how to discount them, mid-year convention, how to take the year frac in terms of the proportionate period of the future when the entire year is given. The only piece that is remaining is WACC. Within WACC also we discussed that how to calculate the weights. The discussion that we have to do today is related to the cost of equity, cost of debt, and cost of preferred. So these are the three costs. These are also called collectively the cost of capital, as in if a business is going to raise some money, what will be the cost that the business will bear for using that money into their business. And a cost to a business would definitely be a income for the investor. Okay, so we will start with the cost of equity. Cost of equity is generally written like K and in E in a subscript. So K stands for cost and E stands for equity. Some people write it like KCE, that means cost of common equity. But anyways, it is generally the common stock only that we are talking about right now. So there are different models that you need to know in terms of the understanding of the cost of equity. One of them is called CAPM model. Then it is a multi-factor, or you can say extended CAPM. Then it is dividend capitalization model, or you can say dividend discount model. Then there is a method called bond yield plus premium approach. So these are the 4 things that we will talk about. Have you heard about any of these? Anyone of you has any knowledge about any of these? or all are new for you? Okay, Ranjan. Okay, Vignesh. Others may have a response. Okay, Raja. Okay, Dheeraj. What about you, Chris, Danisha? Okay, yes, Danisha. Which one have you heard, Danisha? CAPM. Okay. What about you, Ishan? Vinita, Ankita. Okay, Vinita. Okay. So CAPM is definitely one of the most common one, but it is considered as one of the basic one also. So what I always recommend is using this one, the multi-factor or the extended CAPM. If you are sitting for an investment banking interview or any valuation analyst interview, the people taking your interview would like to make sure that you know this one. If you know this one, you know the CAPM as well. Okay, so let's start with the basic one. Let's first talk about CAPM. So CAPM stands for Capital Asset Pricing Model. Okay, the CAPM model basically says that your cost of equity is basically risk-free rate plus beta multiplied by equity risk premium. And equity risk premium can also be written as market rate minus risk-free rate. So there are two versions of CAPM. One is this, and one we can write it like this. Okay. Now let's talk about each of the variables that are present here. The risk-free rate. This is the rate that an investor can earn by investing their money in any security which is risk-free, which if they are not taking any risk and they are getting this much return, this is called a risk-free rate. Because if I say that you go to a bank and you take a loan, the bank will offer different rates to you and me, although we might be buying the same asset because of our CIBIL profile, because of our credit profile, because the bank might find that, okay, if I give money to Chris, he's a better he's a better person, he pays all his bills on time, he has a better CIBIL score. And for Varun, I might not have a better one, so I will get it at a higher rate. The bank is charging a higher rate of interest to offset the additional risk that they are bearing by giving the money to me. So you have heard no pain, no gain. The better the risk, the better the reward. So these all are these applicable here. So basic funda of lending and borrowing, or I would say security market, works on the premise that if there is additional risk, that should be compensated with additional reward. So if there are two investment opportunities, one has a higher risk, I would demand more return because I'm taking additional risk. Now, what is risk? Risk can be default risk. It could be the inflation risk. It could be of different categories. Is the concept clear? Like, why is there a difference between two loans given to the same two different person, or same loan given to two different persons of different rate? Now, you need to understand that if I am an investor, okay, and I invest in a stock of, let's say, any company, and I invest in debt, and I invest in savings account, keep my money in savings account, I will be earning different, I would say, returns. The equity is generally expected to give the highest return because it comes with a lot of risk. Then debt, then savings account. Savings account would hardly give me 2-3% return. Debt might give me, if I invest in PPF, I might get 7-8-9%, something like that. If I invest in equity, I can on an average earn 15%. So that is how it is structured. So as and when I increase my risk appetite, I would be earning a potentially higher. I'm not using the words you do this definitely. I'm saying potentially, because that is, the markets can fluctuate anyway. If COVID came, the markets went up and down in the extreme conditions for different types of businesses. So these things can happen. No one has a control over these, but it is how theoretically or potentially things would happen. Coming back to the equation, so risk-free rate is basically the return that an investor would earn irrespective of taking no risk. So if he is investing in any business that has risk, then he would at least demand something that he could earn from a risk-free asset plus additional increment or additional reward for taking the additional risk. So if I am able to invest in, let's say, government bonds, and I can earn 4% interest rate out of that, then when I'm investing in, let's say, any company, I would say at least I should earn 4% because that is what I'm getting from a government bond. Plus, I should get something extra because I'm investing in stock. That is a risky investment. So that is the premise of this. I'll take a pause. Any questions? Okay, Ranjan. Okay, Vinita. Okay, Vignesh. Okay, Dheeraj. Anisha. Okay. Awesome. So now the question comes, okay, I understand it, but how do we get the risk-free rate? So in any economy, the most trustworthy is the government when it comes to securities. A corporate company can go bankrupt. A small bank might go bankrupt. A big conglomerate can go bankrupt, but the government would never go bankrupt when it comes to returning the money of the public. So the money that is invested in any security backed by the government is considered as a proxy for a risk-free investment. So generally, you will take the treasury bonds or yield or the treasury bond returns for a period that could be as high as 10-year, 20-year, 30-year. Ideally, you should take those many years treasury bond that you expect your business to run. If you expect the business would run for 20 years, 30 years, take accordingly. But if you have no clue, you are like, it's definitely until infinity going concern, then I would recommend taking a 20-year because that is something a very nominal. 30-year is too much and 10-year is too less. So 20-year is my recommendation. And again, this is very subjective. Different analysts might take different to get to a desired valuation number. Okay, but theoretically, it should be the same one as your project or as your business life. But if the business is assumed to be till infinity, then 20-year you can take as a mid one. That you can get from any government website. So for example, if you're talking about US, you're talking about India, you will take that country's risk-free rate. Every country might have a different treasury bond yield. You can directly go to the central bank's website and source the number. But make sure all the variables that you are taking, they should be taken as of the valuation date. If valuation date is 31st, let's say December 2022, then I will not take variables as of today. I will take the variables as of that date. And if the variable is not available as of that date, then take the latest available. So if 31st December was, let's say, Sunday, no data was published, take 29th December, because Saturday, Sunday, no data, 29th Friday, take that data. But don't take any data that is after it. Okay. So you need to make sure that you are living on the valuation date and taking anything that is true that day. I'll tell you one interesting fact here. So let's say now if I do the valuation as of, let's say, 31st March 2023, then as per the Indian calendar, fiscal year 2023 is complete. You will have the entire annual report. But if I'm doing the valuation as of 31st March 2023, on that day, the financials for the entire year would not have been out. You still would have only the 3-quarter data actuals and 1-quarter data projected, right? Although that is immaterial because you are taking 31st March 2023 and the data for the previous, I would say, time frame is a past, but you will assume that the numbers that are available that day are projected only, not the actuals, because that is what the data is available. And any guidance or any, I would say, information that is published by the management after that date should not be considered. Okay, so that was about the risk-free rate. Now we are done with one risk-free rate. Now we'll talk about the market rate. So this is the extra, or I would say this is the return that the market as a whole would generate. Now, market as a whole is very subjective. You can either take the entire, I would say, index like Nifty 50 or Sensex, or you can take a particular category like Bank Nifty. So you can take anything that you feel is a representative of the market of your stock. If you have something you can take the mid cap index accordingly. So you can take anything that you think is a better one. When you are doing it for companies, generally there are different websites that publish the ERP. So you don't have to calculate by yourself. There are standard ERPs that are published. For example, if you go through Duff and Phelps, which has now been rebranded to Crawl, so they have a dedicated division wherein their role is just to publish the ERPs. So you just Google it, you will get the ERP of different countries. It is generally around 5-6% for US and other developed economies. Other reports that you can go through is Morningstar, or even you all would know Aswath Damodaran sir. So they have their own website by the URL of NYU Stern, wherein they publish all of this data. The best or the most trusted one, I would say, is the Crawl one. So that is the recommended one that you should follow. So you can directly get ERP. This is basically the ERP is basically telling you that, okay, if I invest in treasury stock, I will get 4%. But if I invest in a share, then what is the additional return that I can expect? So if the share market on an average gives you 15% and 4% is something that you can anyway get, so 11% is the additional, it is the premium, the equity risk premium. Because of investing in equity and taking a risk, you are getting an 11% extra, that is the premium. So this is how you have to understand it, and this is based on the market. This is not your share. This is the entire equity. So we are talking about the market. What is the market offering you in I would say over and above the risk-free rate? We are not talking about the specific company right now. We are talking about the market. I'll take a pause again. Any questions? Okay. Now, I'll give you two statements. Listen it very carefully. So the cost of equity to the business will be the return for me as an investor. And I will expect something that will satisfy me for the risk that I am taking. So the first thing that I would expect as a at least a version, that I should at least get that much return that I am getting by investing in something that is risk-free. So I should get the risk-free rate. Then since I am investing in equity, irrespective of which company, if I am investing in equity, I'm taking additional risk. So I should get additional return. On an average, the equity risk premium, that means I am expecting that on an average, the market gives 15% and I'm getting 4% from risk free. I should get 11% extra from the market. This is what this is. Now, this is for the market, but I'm not investing in the market. I'm investing in a particular share. I'm doing the valuation of a particular business. So when I'm doing the valuation of a particular business, I need to understand that, okay, market is giving 11% extra, but how is my stock or my subject company related to the overall market? So that is where the beta comes in. The beta tells you how sensitive is your company's performance, share performance versus the overall movement of the market. So if your beta is 1, that means it is an exact replica. So you get 1 into 11%, you get the entire value. But if your beta is 0.9, that means your particular business is less sensitive. Less sensitive means less risk. Less risk means you will get, or you will expect as a rational investor, only 0.9 of the additional, that was 11%. So the beta will decide how sensitive is your stock in relation to the market, in vis-a-vis market, and accordingly the additional premium that the market is offering would be adjusted based on your company's beta. If your beta is 1.1, that means your stock is riskier than the overall market. So you will get 1.1 into 11, that is 12.1% premium over and above the risk-free rate. So this is the role of a beta. Any questions? We have a 20-minute discussion on beta now, but this was about the CAPM. So you understand RF, you understand ERP. I'll give you all the links from where you can get this information. Beta, we will talk further in depth. Any questions till now? Okay. So first of all, you need to understand that beta of 1 means that your stock is as sensitive as market. So if the market changes by 10%, your stock will also change by 10%. But if beta is greater than 1 or less than 1, then this is a different case. Greater than 1 means that if market changes by 10% and beta is, let's say, 1.1, your stock will change by 11%. And if the beta is less than 1, then by change in any percentage of market, your beta, your company will change less. And when I'm saying the company will change, I mean the price of the company, the valuation, the performance, the returns. Okay. So now how to calculate beta? Anyone knows how to calculate beta? No one knows. Anyone of you knew about beta prior to this session? Okay. Let me tell you one more thing then. Can anyone tell me what do you understand by risk? What is your definition of risk? Feel free to type in the chat box or unmute and speak. What is risk? You need to calculate the daily returns for the year and then use the slope function in Excel. That's right, Ruben. That was the answer to previous question, how to calculate beta. That is right. Now, the question is, what is risk? You use this word in your daily vocabulary, but what is the definition or understanding or the concept of risk? Okay, uncertainty related to an investment. That's right. Others, don't you use risk word in your vocabulary? Emergency situations. No, that's not right, Ranjan. Uncertainty is okay, but emergency no. Possibility of losing your investment or losing something. Yeah, now we are getting the answers. Okay, Chris. Possibility of losing. What else? See, I have to break one prejudice of you, a myth of you. So you need to answer question first. So anyone who does not agree with Chris that this is the definition of risk. So all those who agree with Chris, just react a thumbs up to Chris' message. Okay, we have one agreement. We have two, Ranjan, Vinita. Others, Ruben, Ankita, okay. We have Raja. So everywhere agrees. No one dislikes. See, when what Chris is saying and you all are agreeing is the possibility of losing, I'm ignoring investment or something, is the possibility of a loss. That possibility of a loss is one-sided. You are only looking at the bad thing. Risk is not only about the bad thing. Risk is about uncertainty. So what Vinita mentioned previously, that is the right answer. So a possibility of gaining it over and above the expectation and losing over and above the expectation is the answer. So if you are expecting that your business will give you 10% return, and if you get 8% or if you get 12%, both are risk. Just only the downfall is not the risk. The uptrend is also a risk, that if it is different from your expectation. So if this is your expectation and these are your actual numbers that are different on either side of the number line, both is risk. And which statistical tool is used to calculate or provide an answer to the risk? Any guesses? All of you who have studied this in school. Which statistical tool is used to calculate risk? Yes, Chris, that is right. So standard deviation is used to calculate the total risk. Now, the total risk can be divided into two parts. systematic risk and unsystematic risk. So systematic risk is basically the risk that is prevalent for all the companies across the industry, and it cannot be eliminated. Unsystematic risk is specific to a business and can be eliminated. So total risk is represented through standard deviation, or we can say variance. Systematic risk is represented through beta. And what do you mean by unsystematic risk can be eliminated? So you must have always heard from your financial advisors, from your parents, from your friends that do not put all your eggs in a single basket, or you should always have a diversified portfolio when you are investing anywhere. So the reason why they used to say all of this is this fact. So when you are investing in a single security, your risk can be something like this. When you invest in 5 securities, your risk can be here. If you invest in 10, your risk can be here. If you invest in 50, let's say 30, your risk can be here. And then if you invest in 50, your risk will remain flat now. So this is how the risk trajectory works. It reduces with every additional that investment that you make, and this is beta, that is systematic risk, and this is unsystematic risk. So technically we say that unsystematic risk can be diversified away, because if you follow the practice of diversification, your unsystematic risk will go, because if one stock does not perform, the other will perform. So overall the portfolio will do better. But if you have only one stock, then you are bearing a lot of risk. Okay, so beta is a measure of systematic risk only. Now coming back to the point, can you please explain? Once again got confused. Okay, Dheeraj. So Dheeraj, if you invest in, let's say, only HDFC Bank, okay, then you have, let's say, invested 1 lakh rupees in HDFC Bank. Now your portfolio consists of only one stock. So if tomorrow HDFC Bank does something that is not ethical or does not meet the budget or something like that, its shares will go down and your portfolio will crash. But if you invested in PVR, you have invested in HDFC Bank, you have invested in Maruti Suzuki, you have invested in Zomato, you have invested in some debt securities as well. So you have made a different types of investments. Now, if HDFC Bank goes for a toss, your entire portfolio will not go down, because you are invested in different asset classes, that is debt and equity. Within equity, you have invested in different sectors. Zomato is into food. HDFC Bank is banking and financial services. Then you have invested in automobiles. Then you have invested in the PVR, that is into entertainment. So this way you have diversified the portfolio. Once you diversify your portfolio, your unsystematic risk, the risk which was very specific to a particular business, will be eliminated because of the good performance of another company in your portfolio. And that is unsystematic risk. So if unsystematic risk can be eliminated using diversification, the investor will not be compensated for that, will not be rewarded for that risk. That is why we only take beta in terms of our CAPM model calculation. Some questions might come to you from your interviewer that, okay, if risk is represented through standard deviation, why are we not taking standard deviation in our CAPM? Why are we taking beta? Because beta is a measure of systematic risk. And standard deviation is a measure of total risk. Total risk has two parts, systematic and systematic. Unsystematic risk can be eliminated. So if there is something that can be eliminated by the investor himself, why should the market or why should the business reward for it? So that is the full concept there. Everyone, it's clear? Anyone who still wants any Clarity? Okay, Dheeraj. Awesome, Vinita. Okay, let's move on then. So we are talking about the calculation of beta. So beta can be calculated as a covariance of your stock returns and your market returns divided by the variance of the market returns. So this is the technical formula. Now, thanks to Excel, that you don't have to use this formula, you directly have a function slope. Now, if you are talking about slope, so you remember this is the equation of line y is equal to mx plus c. We also discussed this in regression. So we noted that y is the dependent variable, x is an independent variable, c is the constant or alpha or intercept, and m is the slope. If you now put it like cost of equity, risk-free rate, equity risk premium, and beta. So beta is also a slope. And that is why Excel has a function called slope that you can use to calculate the beta. But you need to understand while calculating the beta, y and x. So your y is going to be the company and x is going to be the market. So you have to calculate your company's dependence on the market. So your independent variable will be market and dependent will be the company, the subject company. You need to remember this because if you mess up, things would go other way. Now, I'll not go further in detail of variance, covariance, but you should remember that standard deviation tells you the difference of an expectation of a particular value. Like if you expect that the value would be 10 and you're getting 9, 11, 15, 12, 1. So it will take, this is generally the mean that you calculate, then x minus x bar raised to the power 2, then sigma n minus 1. This was a statistical formula. So variance is basically the square of standard deviation. And when you are doing covariance, so you take sigma, x minus x bar, multiply by y minus y bar, and n minus 1 sigma. You don't take the square. So this is how you do. Now, the covariance can also be written as, so the variance can be written as the standard deviation square of market. This can be written as covariance as a standard deviation of stock, standard deviation of market, and correlation. So if you do this, this is another version of what you can get as the beta formula. Okay. So this is called rho, RHO, correlation coefficient. Okay. Now, there are two more concepts that I'll tell you, but let's first see the practical application of whatever we have learned. You can see the Excel. So everyone can see the Excel, right? So yesterday we saw a different version of calculation of our free cash flows. Now this is a different formatting style. So you start with EBITDA, then you get to EBIT, then you subtract taxes, you get to tax adjusted EBIT. That is again no PAT. Then you add the DNA, the changes in working capital, CapEx, acquisition of intangible, other things, and you get to unlevered free cash flow. So here the cost of equity, you have the beta. This is done on the basis of CAPM. So you have the risk-free rate, you have the beta, you have the market return. So you can easily get the premium, that will be return minus risk-free rate. You have the beta, you have everything, you take the risk-free rate plus beta multiplied by market premium and get to the cost of equity. Now, if we talk about beta, so beta is calculated like this. So we have done the beta calculation using two ways. One is a long formula and one is directly using a slope function. So what we did is, this is done for a company named Boeing. And this was done in 2019. So the numbers are way too back. So we have taken the Boeing company's daily stock price, the closing price, and the S&P 500 as the proxy of the market. We calculated the daily returns. Okay. So we have the daily returns. Now we have to understand the calculation of beta. So beta would be the slope of these returns and these returns. Since we are doing it for Boeing, so Boeing will be our dependent variable and market will be our independent variable. So if you go to slope now, you have y is the dependent. So y, the blue area is this and the red area is x is this. So you get 1.3 as beta. If you do through all the mathematics like standard deviation, you calculate, then you do the square of it and all that stuff, you get this answer, finally 1.3. So this is how you can do for a public company. So if you are doing the valuation of a public company, you can take its share price, take the market index and calculate the beta. Again, this sample is available on LMS. Any questions? That is the next topic to be discussed, Dheeraj. So for a public company, you can take its share price and do it. But what for a private company? The private company does not trade on a stock exchange, so you will not get the share prices. So then how will you calculate the beta? So for calculation of the beta of a private company, you need to identify the peers, the public peers. You need to identify the similar companies of the subject company that are trading on a stock exchange and take their betas. Let's say you get 0.9, 1.1, 0.9, 1.05, 1, 1.2, something like that. These are the betas of your peers. You will take the median of them. They would be acting as the representative, because if your company is not trading, you take the similar companies. And when I say similar, I mean similar in the terms of the business, in terms of the product offerings, in terms of the geography, in terms of the size, and in terms of the profitability. So all of this should be taken into account to identify the peers. That answers your question, Dheeraj? Awesome. But you cannot use these beta directly. So now comes the concept of levered beta and unlevered beta. Before that, I'll let you read this. Just read this. Okay, let's resume. So Dheeraj, Crawl is the name of a website. Okay. It's into business of providing all of these data. This is Crawl. Okay, Dheeraj. Now, when you are doing the valuation of a private company, you cannot directly use the beta of a public company and say, hey, this is the median, I'm using this. No, this is not how it works. So you need to first eliminate the characteristics of the public company from public company's beta. Then add the characteristics of your company into that raw beta and calculate the new beta and use it. I repeat, when you have sourced the beta of a public company, you first need to eliminate the characteristics of that public company from its beta. Then to that adjusted beta, you need to add the characteristics of your subject company's beta to use. And what are those characteristics? And those characteristics are basically related to the capital structure. So here we will be talking about the levered beta and unlevered beta. So let's say there are three public companies that we took, A, B, and C. They have a beta of 0.9, 1.0, and 1.1. So this is the beta of this company based on their own capital structure. We will first calculate an unlevered beta. This is the levered beta. Okay, we will calculate the unlevered beta. That is called, we will unlever it. We will eliminate the influence of their capital structure from this beta. There is a formula that I will tell you. We have calculated the unlevered beta. Now we will use the capital structure, that is the D2E ratio of our subject company, let's say alpha. Let's say it is 2:3, for example. We will use this and relever it. We will add the influence of the capital structure of our subject company. Okay. Then we will get the relevered beta. Then this is something that we will use for our calculation of CAPM models, cost of equity. So we will first unlever the betas of the public companies by their capital structure. Then we will relever it using the subject company's capital structure and then use it. Now I'll show you. First, let me tell you the formula for levered beta and unlevered beta. So if you remember one, the other one is easy. So levered beta is equal to unlevered beta multiplied by 1 plus 1 minus tax rate multiplied by the D2E. So if you want unlevered beta, you take it to the denominator. Okay, simple. So this is the formula for levered beta. If you want unlevered beta, this goes to the denominator. Now let's go and see a few samples. So this is a GPC beta sheet that has been prepared to calculate the beta of the private company. Now what is happening here is you have these companies, these are the comps, comparables, peers, or related or similar companies. Then you have their specific companies betas, which is the levered beta they have, and their debt to equity ratio. You will first calculate the unlevered beta. Unlevered beta will be calculated considering their respective beta and their respective debt to equity ratio. Okay. Now, once you have calculated the unlevered beta, you will relever this. Relevering would be happening based on the target companies, the subject companies debt to equity ratio. Okay. And once you have this, then you can decide whether you want to include it or not. If you say yes, the value will come. If you say no, the value will not come. So once you have all of this, you can take the average, median, and all these statistical calculations and use it. So now if you go to the WAC sheet, this 1.4x is coming from the median of the betas. So you first unlever it based on the based on the respective companies debt to equity, and then you relever it based on your companies that you are doing valuation for. On the basis of that, you will use the debt to equity ratio and relever it. So this is how you do it for private companies. Now the question is, how do I get all of this data? So there are different databases that you can use. So some databases are paid, like Capital IQ, Bloomberg, FactSet, that you can use. Some databases are free, like Money Control, Yahoo Finance, that you can use. Also, you can go through the different reports that are published by the equity research analysts and source the data from. But once you are doing it on a recurring basis and as a part of a profession, you will have access to databases. All the companies buy subscriptions and you can directly source the number from there. The best way when you are doing it is to source a 5-year beta. But if the company is not 5-year old, when it comes to being listed, you can take 2-year, 1 year to the extent available. You should take the maximum available data up to 5 years for beta. So that was the concept for using comparable companies data for calculation of the beta. Now, any questions you have up till here? Otherwise, we will move to the multi-factor model. Can I have a quick cheer up, a question or a thumbs up in the chat box? I think there's a lot of silence today. A quick cheer up. Okay, Ranjan. Let's have it from everyone. Okay, Vignesh. Vinita, okay. Okay, Ruben. Okay, Swati. Okay, Danisha. Okay, Chris. Okay, Raja. Ishan, you are the most silent one in the session. Always. Ankita, everything okay? Ankita, all is good? Do you have any queries? Anything heavy? Okay. Let's continue then. Just give me a second. Okay. Now we will talk about the multi-factor model. So the cost of equity is equal to risk-free rate plus beta into equity risk premium. This is what we have studied. This is CAPM. But when we add more, that is, we create an extended CAPM. We add SCRP, we add CSRP, and we add CRP. So we'll talk about these three. SCRP stands for Small Company Risk Premium. CSRP stands for Company Specific Risk Premium. And CRP stands for Country Risk Premium. So until now, what we were doing is in CAPM, we were considering risk-free rate. That is the minimum for investing in anything. Then we were talking about equity and understanding the performance of our share versus the equity market. But we are not doing anything apart from this. Now we are considering from other dimensions as well. We are considering how much should we be compensated for a small company, that is based on the size. So if there are two companies, one is Tata and one is Bata. Sorry, let's say one is Tata and one is any other small company which are into similar businesses. Then Tata would always have a leverage, would always have an advantage because it is a big business. It can absorb a lot of shocks that the economy or that the market would give to them. But a small business would go for a toss if there is a long loss. So big companies have less risk and small companies have more risk. And if the company is small, then you need to be compensated higher. You need to be rewarded higher for bearing that small company risk. And small company risk premium, this comes from a report again that is published by Kroll or Morningstar. And these are paid reports. These are not available on internet that you go and find out. These are paid reports. And you need to buy a subscription. So as a individual student, you cannot access these, but once you are working with a company, they might have a subscription and they can get it from there. It is called a capital handbook that you can refer to. So you need to understand the concept that it is the risk premium that is added for a company being small. So there are ranges for a company that is in the range of this much to that much. It will be 5%, it will be 2%, it would be 0.5%. So the smaller the company, the higher the premium that you would be added. And all of this increases the cost of equity, and this increases the cost of equity, and hence the denominator increases and the valuation decreases. So as and when you find more risk in any investment, the valuation would reduce of the company. So that is about the small company risk premium. Then you have the CRP, that is country risk premium. This is valid for those companies which have operations in multiple nations. If your company has operation in only one single country, you are taking the variables of that country. This is done. There is no need of CRP. But if you have operations in one country and you also have operations in another country, then you will take a country risk premium because of the multiple nations being involved in your business. There is a specific formula, but generally formulas are not used because they are too technical, and you can directly go to the website of NYU Stern, that is, and the data is maintained by Aswath Damodaran sir, and you can directly source the CRP for that particular country from there, and it is how the industry follows it and it is used. Now coming to the company specific risk premium. So everything else is coming from a particular source. Risk-free rate is coming from a source. Equity risk premium coming from a source, beta also. So there is very less room for an analyst to make any adjustments or add any subjectivity to the valuation analysis. But CSRP, also called alpha, this is the place where the analyst can play. This is a risk that the analyst thinks that the business has. So if you are working on a valuation analysis, you think that the company has made the projections that are too high. Some analysts do not like to alter the projections because they are the management data. Instead, if they believe there is additional risk, they will add CSRP. A nominal 3% is okay, but it could go as high as 5 to 8% if you think there is a lot of risk. The risk could be that the management has overstated their expectations in terms of the projections. The management, you know that the management has planning to, let's say, fire their CFO and fire their CTO, which would have an adverse impact on their business. You know that the industry that they are working is going to be coming into a lot of taxes in the coming future, or there would be a lot of restructuring that would happen in the industry, and this company does not have that much capability. So all of this would lead to factors that would increase the risk and would be captured through CSRP. And once you combine all of this, it becomes the cost of equity. See, theoretically, yes, CSRP is subjective, but it can be made objective as well. So what Big Fours follow is, so 3 weeks back, I was discussing with one of the directors of PwC on how would they do a valuation of any particular business. So she told me that what we as a practice follow here is we first prepare a model. We first say that based on the assumptions that are given, this is what their company believes is the valuation. And then we prepare another model wherein we adjust the projections. Everything that the projections are overstated, we adjust them and we run the valuation again. And whatever comes the difference in the valuation, we take that difference as the CSRP so that we can add that in the discount rate and get the lower valuation. So this way they can make it quantitative or objective. Long story short, it is subjective but can be made objective. Now you can read this. Yes, Danisha, that is right. But only if you are doing it for a company that is based out of US. You cannot apply that for India. So that is a US ERP. So any company that you are, so Colgate, if you are doing it for US, then you can take this. See, Chris, we are talking about cost of equity. And for cost of equity, we are talking about only the equity. So the agenda might be something, but the valuation that we are talking about is for the company as a whole, enterprise value. Okay. And the variables here that we are talking is very specific to the cost of equity. So it is specific to equity. Answer is this, please. Ankita, you have to skip this formula. This is a part of your CFA curriculum. You will never use this formula in the valuation. You can directly go through the unvalued turn website. But if you still want to understand it, you need to understand it like that. There is a special. There are two countries. They will be having two different economies, and to understand how is this going to be a risk by investing in one and not in other, so you need to take certain proxies. That certain proxies would be taken into account as the equity index of the country and equity index in terms of the like the developed market. So once you have the developed market, you have a developing market, you will establish a relationship between the two and multiply it with the yield spread. Yield spread basically refers to the buying rate and the selling rate of the sovereign bond. Yeah. Now, once you combine everything, this is how it would look like. You will take the risk premium multiplied by beta plus risk-free rate plus company specific country risk and small company. You will get the cost of equity. You multiply it with the weightage. You get through the WACC. And now we'll talk about cost of debt as next. Let's first see one more example in the model. So this is how you can create a WAC sheet. So you have the beta, you have the equity risk premium, it is coming from Duff and Phelps website. You multiplied this, then add the risk-free rate, then add the company specific, country specific. This is coming from the Duff and Phelps handbook. Like a small company, then you will get to the equity. (1.4) into 5.5 plus 1.8 plus 5 plus 0 plus 5.6. This is your cost of equity. Okay. This is how you use the multi-factor model. Now, there are two more methods how to calculate the cost of equity. One is dividend capitalization model, or we can say dividend discount model. And then there is a bond yield plus premium approach. So this is easy, bond yield plus premium approach. So what happens here is, you understand that debt is a cheaper item and equity is a costly item because debt has less risk. Less risk translates to less cost, and equity has more risk, and a higher risk translates to higher cost. Why is it less risk and high risk? Because debt will get a regular interest payment, but equity does not have any commitment. The dividends might be declared, might not be declared, but it has a potential for large appreciation in the value. So bond, if we say that bond is giving us 7%, we can add 3% more, and this is going to be our cost. This is a dirty maths that we do as quick, that okay, if the company has issued bond of 7%, I think let's add 3% or 4%, and that would be the cost of equity. This is this simple and this quick, but this does not have any rationale. This does not have any science behind it. So this is a very subjective measure, and only if you are going to do something very quick or very dirty in terms of the maths, then only this is used. But this is not a recommended method any day. Coming to the dividend capitalization and dividend discount model. So I'm sure you must have read this equation somewhere in your life. That the price of a share is basically the dividend last declared multiplied by 1 plus growth rate divided by KE minus G. This is the price of a dividend that is calculated. If you have done any certification in finance prior or in your college, you must have learned about this. This is called dividend discount model or dividend capitalization model. This is how you calculate the intrinsic value of a share that declares dividend on a regular basis. Now, if you see, this is very synonymous to the terminal value of Gordon growth. So if you take this as the terminal value, you take this as the free cash flow, the latest 1 plus growth, WAC minus G. This is very similar in terms of the structure. So if I change the places, I can get the cost of equity. If I take it to the numerator, D naught 1 plus G divided by P naught and plus G. This is going to be the cost of equity equation, wherein D naught represents the dividend that was latest declared, 1 plus growth, G represents again the perpetuity growth rate, P naught represents the price of the share in the market. Okay. Now, there is a concept of sustainable growth rate. So sustainable growth rate basically comes from the concept that if you are generating net income out of your business, then you have two options. Either you can retain it or you can distribute it as dividend. Okay. The portion that is retained is generally invested into the business again for further growth, and you can further generate net income on that because this gets added to the equity portion. And this is the portion that is distributed is called dividend payout ratio, and the retained portion is called retention rate. So if let's say on equity, the net income that is generated is called return on equity. Like say if I have invested 1,000 and I'm generating 100, that means ROE is 10%. Of that ROE, if I'm investing thus Let's say 30% I'm retaining and 70% I'm distributing. So 10% multiplied by 30% I'm retaining. That would be further invested into the business for growth. That is called your sustainable growth rate. So sustainable growth rate is basically the return on equity multiplied by the retention rate, because this is the income that was generated out of your equity investment and further invested back into the business for further growth. So this, if you continue with this cycle, your business will keep on progressing at a 3% growth rate. That is the concept of a sustainable growth rate. So this is done. This is done. You can read this. Done. It's the same with a different branding. So D1 is here is basically D naught 1 plus G. D1 is the next period's dividend. D naught is previous. So if you grow the previous one, you get to the next one. Okay, let's talk about the cost of preferred and cost of debt now. So cost of preferred is comparatively simple. You don't have different methods. What you do is you take the dividend that is declared by the preferred and you divide it by the market price of the preferred equity. You simply get the cost of preferred. Okay. Sometimes you will hear people saying that you have to calculate four. One is cost of preferred, one is cost of debt, one is cost of equity, and one is cost of retained earning. So cost of retained earning will have the same cost as the cost of equity because it is eventually going to be added into cost of equity. This is hardly 0.1% of the analyst population that does it that way. But you should know that if someone asks you to trick you, then the answer is the cost of equity. So this was about the cost of preferred, very simple. Just take the dividend and divide it by the market price. Now cost of debt has four methods. One is based on the historical performance or the historical income statement or historical interest cost. What you do is this can be done in different methods. If it is a public company, you can go to the annual report. They would have given the instructions or they would have given the commentary as to what was the interest, the rate that was charged to them based on the different debt they have taken. They might have taken three debts, for example. So three debts have what interest rate. They might give you even a weighted average interest cost. You can use that. If it is a private company and you don't have any annual report or publicly available data, go to the financial statements, take the income statement from the take the interest cost from the income statement and divide it by the long-term debt or the short-term debt that is interest bearing. So any interest bearing debt from the liability of the balance sheet and calculate the effective interest rate. So these are the two ways you can get the historical. I repeat, if you have an annual report that is published, you go through it. If there is any mention of what was the weighted average interest cost or individual interest cost, take that. Otherwise, go to the financial statements, take the interest cost from the income statement divided by the interest bearing debt from the balance sheet, and you get the effective interest rate. The second method is you go through the management guidance. If they have provided any commentary in the MD&A section or provided any comments in the annual report anywhere that they are in talks with a company that is planning to give them some debt or any lender that is planning to give them some debt at this rate, then the game is sorted. You have the exact value. Otherwise, you will have to go through the credit rating of the company. So if you go through the credit rating of the company, every company has a credit rating. Let's say the credit rating of a company is AAA or BAA. Then as you go below the credit rating, the risk increases and the interest cost increases. So if the credit rating of the company is available, you can just go to Google and see if this is the credit rating, what is the cost of debt that would be applicable for this particular company as of a particular date. You can get through Y charts. This is a website name, Y charts, on the basis of this. If there is nothing given, you don't have any clarity, then go with the proxy credit rating. So proxy, you can use the BAA. So BAA is considered as a proxy credit rating because this is considered as the mid one. This is not too risky, not too light on the riskiness. And you can consider this and source the exact interest yield for this particular credit rating and use it. So these are the four different methods that you can use to calculate the cost of debt. Once you have the cost of debt, you have to do 1 minus T and then multiply it by the weightage of debt and package it into a WACC equation. Okay, done. Next method is the cost approach. Within cost approach, we have NAV. So NAV stands for net asset value. This is comparatively very easy. So if you have the balance sheet, this is how it would look like. You have current asset, non-current asset, you have total asset. You have current liability, non-current liability, you have total liability. Then you have equity and you have total liability plus equity. So if you subtract total liabilities from total assets, this is what will remain. And this is the premise of your NAV. So NAV is basically telling you what is the worth of the equity considering the assets and liabilities on your balance sheet. Sometimes you take the book value, sometimes you calculate the fair value, sometimes you assume that the book value is same as the fair value, but make sure that the balance sheet that you are using is the latest one. And if it is not available as of the valuation date, you should give a comment that based on the management guidance we have, it is the balance sheet as of X date has been taken relevant for the valuation date, assuming there were no material differences in the figures. So this is how you have to do. So the NAV becomes total of liability minus total of assets. That is current liability plus non-current liability minus current asset and non-current asset. So this is a simple concept. And this is generally used for those type of businesses which are asset heavy, which are capital intensive, which you don't want to do it through their future growth prospects, but you want to do it based on the investments that have been made into the business. And generally, for the companies that are high growth companies, the NAV will give you such a low valuation that people don't even give weightage. So it acts like a baseline for the valuation that even if the company does nothing, you can sell the assets, pay off your liabilities, and this is what you will get. Okay, so that's it for today. So today is 28th Jan. The next weekend lies on 3rd and 4th Feb. There won't be any classes on 3rd and 4th Feb as I'll be traveling out of town. We will have the next session on 10th, 11th Feb weekend. There is one more session that I think we will have to do for evaluation. There is one Colgate doubt session that we will have. We will have a combined Colgate doubt session. I'm not talking only about the financial model. We have to discuss the financial model plus valuation model. So you complete your financial statements, you complete the projections, you also do the DCF valuation for Colgate, and then try to complete it by 9th Feb so that we can have, you will have in the evening, both the sessions would be in the evening, the valuation 4th session, and it has no relationship with the Colgate model case study. And you will have a doubt session also. One will be on 10th evening, one will be on 11th evening. Okay. So this is going to be your no calendar for this and calendar for this weekend. Okay. And make sure this is going to be your final doubt session for Colgate. So you ask everything and anything that you want to ask. No sessions on Colgate after this. Okay, thank you. Have a great Sunday. Have a great next weekend. We will meet after 2 weekends now. Till then, bye-bye. Thank you. Okay, thank you everyone. Bye. Thank you. Okay, let's start. So, good evening, everyone. This is going to be the valuation class 4, and we'll cover the outstanding topics. So, I'll just give you a quick recap. There are broadly 3 different approaches of doing the valuation. The first one is income approach, second one is market approach, and the third one is cost approach. Income approach has basically 2 methods. One is related to the DCF valuation, that is the most common one used in the industry, then the capitalized earning method. Okay, then market approach has 2 methods, GPC and GTM. GPC stands for Guideline Public Comparables, also known by the name of Public Comps, COMPS, P for parrot. Trading comparables, and the other one is GTM, that means Guideline Transaction Multiples, also known by the name of transaction comparables or transaction comps, also known by the name of similar transaction method or precedent transaction method. So all these are the name of GTM. Within cost, we have NAV method. So this is something that we have covered. We'll be talking about these two. So the cost one is a very basic thing. So as I had previously mentioned, there are 3 different definitions of net that we generally use in our accounting. One is net debt, that means total debt minus cash and cash equivalents. Then there is net fixed asset, that is gross fixed asset minus depreciation is equal to net fixed asset. And then there is a net asset, which is basically the total of assets minus total of liability. So indirectly, we are talking about the equity portion of the balance sheet. Now, generally, we have to calculate the fair value of the total assets and total liabilities and then arrive at the implied net asset value. And this is generally applicable for those businesses which do not have any future prospects or which are very capital intensive or which are about to get in the liquidation stage, and the assets that you have are the only source of money that you will generate from the business. And if it is a company that has high fundamental values, great growth prospects, then this is not going to be the ideal choice of valuation. Okay, this will just set the floor of the valuation, that this should be the minimum valuation of the company. So what you have to do is you have to take the balance sheet as of the valuation date. If it is not available, you will take the latest balance sheet and assume that the numbers are still valid. And if they are require any adjustment or require any uh, overhaul on the numbers, then you will do that and then arrive at the net asset value. So this is referred to the cost approach. This is basically called the cost approach because everything that is sitting in the balance sheet is on the cost method. So hence it is called the cost approach. We're gonna have a quick read here. Then, okay. Now we will talk about the other one, that is the market approach. It is also known by the name of relative valuation. And this is a very common thing that we do. And in fact, we have done that in the LBO model as well. So what happens? Let's go and learn this with an example. Okay, let's say there are three people. One is Dhanisha, one is Manoj, and one is Tavleen. Okay, Dhanisha and Manoj recently bought a house in a particular society. So Dhanisha bought a, I would say, 1,000 square feet house, and Manoj bought a, let's say, 1,300 square feet house in the same society with same amenities. Only the difference is the size. Okay. Now the information that is provided apart from this is that Dhanisha bought this house at 1 crore rupees and Manoj bought it at 1.3 crore. Now, Tavleen wants to buy a house in this society and she is looking for something like 1,200 square feet. So, what do you think would be the ideal value or the ballpark figure in terms of the value of that house? What's your best guess here? Okay, what about others? Everyone agrees it would be 1.2? Because what we are doing is we are saying that 1 CR. Okay. 1 CR divided by 1,000 square feet. So basically it is 10,000 rupees per square feet. This is the rate. This is the rate in terms of the size. And then we multiply it by 1,200 and we get 1.2 CR. So what is happening here is, considering the houses are similar in design, in amenities, in location, in the housekeeping services, in terms of everything, in terms of the construction, the difference is the differential point that we can, that I would say the house one is different from house two is the size, and size is acting as our metric to influence the value of this house. So in the first case, it was 1 CR and we based it on the size. 1.3 CR, we based it on the size, and hence a 1,200 square feet house should be 1.2 CR. Here, we did not get into the valuation of this house based on its fundamentals. We went it in terms of the market approach. How are the similar houses priced in the market? This is relative valuation. Similar thing that we will apply in the terms of our businesses. So there are two things. One is GPC, that is public comparables, and the other one is transaction comparables. So public comparable basically is a method that says that you identify the peers, the similar companies like your subject company that are trading on the stock exchange, and you see what are they valued at in terms of their metric. And metric is generally the financial metric. The common multiples that are used are EV by revenue, P by E, EV by EBITDA. These are few of the common. If it's a bank, sometimes we use P by B as well. So these are a few common valuation multiples that are used. So what you do is you first identify the different peers that are trading in the stock exchange and then do some mathematics and get this. The broad difference between public and transaction comps is that in terms of transaction comps, you are not interested in those companies that are trading on stock exchange. You are rather interested in those companies that underwent any merger or acquisition or private placement or an IPO or whatever is the agenda for valuing the subject company that you are working on. So if your subject company is planning to get acquired, then you will look for the past 5 years transactions in acquisition of the similar companies and see how were they valued in terms of their revenue, in terms of their EBITDA, in terms of their net profit. So this is the basic logic or basic concept of these two methods. Any question? Okay, Tanisha, what about the others? Neeraj, Mitakshi, Tavleen? Okay. So these should be the two questions that we should discuss as the next concept. First, okay, we understand what is public comparable method, but we have been saying peers, but how do we identify what are the peers? So there are certain criteria that we need to follow and say that this is a company that is similar to my business and this is a company that is not similar to my business. So first of all is the industry. So I cannot compare HDFC Bank with Maruti Suzuki. They are into two different businesses altogether. So industry classification is important. Then within the industry, their business description is very important to be read. So for example, Ola, My and Maruti Suzuki, they both are in the similar industry, automobiles, but their businesses are different. Ola is into electric scooters and Maruti Suzuki is more into cars. So that's why they are a bit different. They might be a comparable company, but not a very similar company. So it would be given a backseat in the analysis. So business description is the second one. Then is the geography, because every country have their own dynamics, their dynamics in terms of their economy, in terms of their demographics change. So that also impacts the valuation. So having a comparable company within the same geography is very important. Then if we are doing it, we should be doing it for the similar sizes. It doesn't make sense to compare a company that is very small with a very large company. Ideally, they should be similar. But size is a criteria which gets a bit less importance when it is public comparables, because generally small companies are not publicly listed. So you have to go with the bigger companies. Then the next one is the profitability. You might want to go with only those companies which are profitable. So that is another criteria. And then if it is a GPC, then you might be interested only in those companies which are on a recognized stock exchange. You should avoid OTC companies. And in case of a transaction comms, the additional one is the transaction type and the period of transaction, like last 3 years, last 5 years, the recent one. And in GPC, you should avoid OTC, and the mandatory criteria is that it should be publicly listed. You should not go with the private companies. So these are the broad criteria that you follow. Now, how do I follow? What should I do? So there are certain databases that are in practice, like Bloomberg, Capital IQ. So full name is S&P Capital IQ, FactSet, PitchBook. So these are the databases. You log in into that database. These all are paid databases and they are very costly. So they are only owned by the businesses. No, like you just can't go to Google and buy the subscription and do it. So the company that you would be working with, they might have the subscription to this. So go to these databases. There is a section for screening. So the process of identifying the peers is technically called screening. So it means to screen. So you will do all the criteria. You will get a list. Then you will download that and you will read every company. You will go through the website of the companies and see if they are relevant or not, if they are suitable as a peer or not, or the valuation. If it is an outlier, you will eliminate that, because the numbers could be vague in terms of outlier. Then that would be eliminated so that your analysis is not distorted. That is the answer to this question. And this is a common question that would be asked by everyone. And this is something you will do day in, day out if you are into investment banking, into valuation advisory, into private equity, into any portfolio management or financial services. Now the question is how to value using this method. So for example, let's say we have a GPC. We are doing it for company Alpha. Okay. We identified there are A, B, C, D, E, 5 peers. Okay. You remember in DCA, we talked about unlevered beta, relevered beta. Similar type of structure we will prepare here. So we identified these companies. We will say that the EV by revenue multiple for A is, let's say, 3.1x. Here it is 4.3x. Here it is 1.7x. Here it is 6.7x. Here it is 4.2x. So then we will use this data, and let's say we are, for example, we are taking a median, and let's say median comes out something like 5x, for example. We will multiply 5x with the revenue of our subject company. Let's say it is 10,000. So our company's valuation will become 50,000. This is how we will do it. I'm saying let's assume we are taking median because we are not always taking a median. This is another question that we'll talk about. So this is how a comp sheet would look like. Similarly, would be the transactions. But in transactions, there are two type of companies. One is if we are talking about the transactions that had happened in the past. So one company would have acquired, another would have gotten acquired. So the company that is acquiring it would be acquirer, and the company that was acquired will be the target. So your subject company should resonate with the target companies. It doesn't matter if the acquirer was a related company or a similar company or not, but you need to make sure that the target company was very similar, was the peer of your subject company. So all these criteria should be applied to the target company. Okay, now the next question comes in. You said not always median, then what should I take? So if these are the companies, generally you will be doing it for 8 to 12 companies. That is a good number to take in terms of the peers. Also, one more thing I should tell you, when you are doing it for the transaction comps, one another criteria that you will add is the availability of data, because generally these companies that are private do not disclose the transaction details. So if 100 transactions happened in a particular period, hardly 10 to 11 would have actually disclosed the details. And if the details are not disclosed, you have nothing to do your valuation analysis on. So you will just eliminate or ignore those transactions. But if you are preparing a pitch deck for a investment bank, wherein you have to show that how active this industry is, then your agenda is not valuation. The agenda is to show the great and the vibrant activities of acquisitions in a particular industry. Then you will take all of them. But if you are doing it for valuation, then you need actually the multiples. And if the data is not disclosed, they are as good as nothing. Now coming to this, if not median, then what? So you will calculate minimum, maximum, 25th percentile, 75th percentile, average, and median, everything. And then you will position on the basis of three different factors. One is going to be the size, one is going to be the profitability, and one is going to be the growth. So size, you will take the revenue and EBITDA numbers, and you will see your subject company, for example, is let's say these are in the descending order of everything. Okay, let's assume this. So let's say my subject company, as per my subject company, it lies somewhere here in terms of the size. In terms of the growth, it lies at the maximum, and in terms of the profitability, let's assume it lies here only. Then there are two points that are given to over here and 1 point here. So I can easily take the median one. So I will take the median. Ignore the values. I'm just saying that in terms of the position, if on the basis of profitability, your company is positioned at the bottom, in terms of your growth, it is positioned at the top, and in terms of the other criteria, that is size, it is positioned at bottoms, and you will take on an average the more on the bottom side, maybe the 75th one. So this is how you have to structure your analysis. The benchmarking of your company's profitability, size, and growth is the criteria to decide which multiple to take. The minimum multiple, or the 25th percentile, or the median, or 75th, or the maximum. Any questions? Okay, now we have to calculate all or any of one. No, you have to calculate all. So if you go to the samples that are available, your analysis should be comprehensive. You should not do only that is relevant. You should do everything and identify and point out what is relevant. That's a good sign of an analysis. You see, You have this. So here it is given, the commentary is given that, hey, we are taking the EBITDA multiple at the median because on the size basis, it is below the median. That means a lower multiple. On the growth basis, it is between median and third quartile, implies a little higher. And on the profitability basis, it is near the third quartile. So 2 points are above, like one is median and third quartile, one is above third quartile, and one is lower. So on an average, you should take a median. That is how the class logic or the reasoning is given. So you are taking a median. Then you have one sheet for the description. So why peers, why only these peers you have taken? So you have to mention the description so that people can read the business model of these companies. Then these are the different values that you will take. So this is EV by sales. That means EV by revenue, EV by EBITDA, EV by EBIT, and P by E. So all these ratios are calculated. For public comparables, it is always recommended that you sort them on the basis of the enterprise value. And in terms of the transaction comps, you should sort them in the chronological order from latest to oldest. Okay, these are the operating comps from where you decide the profitability, the margins, and the growth. Then this is on the size. Then this is GTM. Similarly, you write the commentary, which multiple you are taking, you multiply it with the financial metric and you get the valuation. So here are the GTM multiples. This is the acquirer, which acquired. If they have not disclosed the name of their acquirer, you can write undisclosed investor. Then target, the description, as I mentioned, will come only for the target. Then you mention the date, it is in the chronological order. And then you mention the multiples that you have to take. And then it is done, the relative ranking is done here. Then this is the cost approach. So this is a comprehensive valuation model sample that is available that you can go through. Okay. Now I have a question for you guys. I will write two different valuation multiples. You tell me if you are okay to use both or which one sounds better or both are good. One is EV by revenue and one is P by revenue. Obviously, this is good. I've been saying this a lot, but is the second one also good or you will only use the first one? This is EV by revenue, this is P by revenue. Or EV by sales and P by sales if that makes it more comfortable. So first one is okay to use. Is the second one also okay to use? Yes or no with a reason? No, EV by revenue is okay. But do you think P by revenue has any weird behavior or you are comfortable with P by revenue? This is perfectly fine. Star rating. This is a very good conceptual concept here. But I want you guys to take a shot first. But the weird behavior, Tavleen. If you want to unmute and speak, feel free to do that. What's the weird behavior here? I'll give you 1 more minute to think. P by revenue will consider the value that investors think is the value of the company. No, Danisha, no. You are heading in the because of the scope they cover. Pauline, what do you mean by scope here? Elaborate. Okay, let me tell you. You remember the difference between enterprise value and equity value? Enterprise value is the entire business, and equity value is only the portion of the entire enterprise value, only one portion of it, right? Now, revenue is something that is attributable to the entire company. Okay, revenue is something that the entire business is generating. So it is before any allocation is made to any of the capital contributors. So it is for everyone. And hence it makes the best pair with enterprise value. Whereas equity value is a portion of the capital. It is not the entire capital. So having something in the denominator that is for everyone and having something in the numerator that is a partial thing is the weird behavior. So for that reason, you will always see EV by EBITDA and P by E. So EBITDA basically means earning before interest, tax, depreciation, amortization. This is the earning before the interest. That means nothing has been paid to any of the capital contributors. And so is the EV. That is for everyone. So both are in sync. But when we talk about P and E, E definitely means the earning per share and price per share, or we can say the market capitalization by the net profit. So in either case, the earnings is after paying off all the debt obligations in terms of the interest and everything. And in the numerator also you have equity value that I can use say price or market cap. So here they are both in sync. So that is why you will see P by E very often in EV by EBITDA. It doesn't mean that people don't use this. People use it. It is very commonly used, but it comes with a loophole. Everyone understands what it is missing? Awesome. Now, we have already discussed that it is a very common strategy for different, I would say, investors to pay a premium. And we had a discussion that there are three values: deal value, offer value, and transaction value. I'll just repeat it. So let's say you are an investor and you are buying, let's say, 40% stake in a company for 400 rupees. So then 400 is the deal value. And this is called proportionate equity value. This is the total equity value. So if 40% is valued at 400, that means the 100% would be valued at 1000. So your offer value, that is the total equity value, will be 1000. And let's say there is a net debt of 300, then this will make it 1300. That is will be the enterprise value. So total enterprise value is transaction value, offer value is total equity value, and deal value is the proportionate equity value. So this is how you have to use the terms. When we were building LBO model, we discussed this. When we are talking about the M&A model, we will talk about this. Okay. Now, whenever you are investing in any company, you are not always doing it with the cash. Sometimes you might be issuing the shares of your company. For example, company Alpha acquires company Beta. Then it is not always the case that Alpha will be paying the owners, the past owners or the old owners of company Beta some cash. They might say that, hey, we are going to, since I'm acquiring this company, it will not longer exist as you. It will be combined to my business. So I might give you certain shares of my business. So that will be an equity deal. And it could be possible that you are paying cash and that cash could come from your reserves, or you might take a loan and then pay cash. So these are different ways of how a transaction can be funded. Just FYI. Okay. Now, can you please explain once again what's Tavleen? Which part? This one. This one, Tavleen. You need to tell me which part. Okay. If you're talking about this one, so I'm saying if you are buying 40% stake at 400, that means the implied total is 1000. So 400 divided by 40%, the 100% is valued at 1000, and that's offer value. If you have to go from equity value to enterprise value, you need to add the net debt, preferred, minority, and other obligations. So that is how you get to the net, the enterprise value. Enterprise value is also known by the name of transaction value. Total equity value is also known by the name of offer value. And the proportionate equity value is deal value. So this is one thing that I told. Second thing that I told was, okay, perfect then. Okay, so you have the DCF. Let's say DCF gives you that the company is valued at 100. Then you have market approach. Within market approach, GPC says it is no, it is valued at 110. Now GTM says no, it is valued at 105. And then NAV comes into the picture and says no, it is valued at 60. So first of all, this is okay to give a very low figure. But ideally, all these methods will not give you the same valuation. It is very like rarest of the rare case that you will get the same valuation number from all the methods. But they should not be too far. Ideally, they should be in the range of 15% to 20% in the deviation. So the lowest is 100. So the above one should be maximum 115, 120. So they should be close knit. They cannot be the same, but they have to be very close knit. Now, once you have this, you can give this as 33% weightage, 33% weightage, and 33% weightage. So by that, you will give equal weightage. If you want to give someone else more weightage, you have to justify it. But in basic sense, you can get the equal weightage. So giving an equal weightage, you can get the valuation. That will be called the blended valuation. So the valuation that you get in terms of the weighted average is called the blended valuation. And this is going to be the valuation that you will consider based on the different approaches. And then you can calculate the implied multiple. So this is the valuation, this is the enterprise value. You can see how is it railing in terms of the EV by revenue, EV by EBITDA for different years. It could be for the last 12 months, for the next 12 months, for the fiscal year 23, 24, whatever is the best year that you will take as the proxy of your performance. Whatever year you think is justifying, is a true representation of your financial performance, take that. And this is how the sheet would look like. So, Chris, that is a good question. Theoretically, you should take equal weightage. But if you think that your company's projections are not well enough, and there is a lot of risk that is associated, that is why your DCF is coming too low, but you think the market is valuing you more. That is the reason when you will not go with the market value, because you think the market is valuing in terms of the rational sense, but your company is in a bad condition. And the knowledge of having that company in the bad condition is more valuable than looking at the industry on an average. Then you will give income approach more weightage. And if it is the other case, your company, you are saying that I will do this, I will do that, your projections are way too high, but the market is giving you no. I think this is the norm. The company's management might be too optimistic, but the market is going very realistic, then the market approach will have more weightage. Okay, Chris? Now, once you have these methods, you have different sheets that are doing the valuation. You give the weightage, you get this, and you get the blended valuation. Then you calculate what are the implied multiples. Then you add the cash, subtract the debt, and you get to the equity value. So this is how you have to prepare your valuation summary. Then the next thing that is very, very important is the football field analysis. So this is a chart that you need to prepare. See, everything that you are doing in terms of the valuation and in terms of everything, it is very well subjective because it is based on your assumptions and the variables that you take. And the assumptions that you take might not be 100% truth when it comes to the actual D-Day in the future. So you will have to give a range of valuation on the basis of this. So there could be a certain stress testing that you will do. So let's say we want to do a 10% toggle that the numbers might go plus minus 10%. So this is the valuation that is coming from different methods that we have here. Okay, we are flowing it them. And then we are saying that it might go 10% high. So this multiplied by 1 plus 10%, it might go 10% down. So this multiplied by 1 minus 10%. Similarly, we are getting everything and we are calculating the difference. Now we will be using these three sections or three columns to create a football field analysis chart. And this is a football field analysis chart. So I'll do it in front of you now. I'll not take the cost approach. I'll just take these three. Your interface might be different when it comes to Windows, but this is how you have to take. So you have to take this stacked bar. Okay, then what you have to do is first, I don't need the blank one. Okay, so I'll just go to select data. I'll see what are the things there. So I have the name here. It is valuation. It is okay. But the area that is being selected is from 7. Oh, okay. It is from 7. So I will instead select it from 8 to 11. Okay. And I'll do enter. First, let's delete the existing one. 8 to 11, enter. Okay. Now, I'll again select data. I'll go for valuation high. What is the area? Again, it is 7 to 11. I'll do 8 to 11. Okay, this is done. Now, what is going to happen is, first of all, I don't need the valuation column. So I will get rid of the valuation column. So valuation, I will just delete it. Now I want the low to be at the top, then difference, and then high. This is going to be the order that I want it to maintain. Then I don't want to show these. I will make them the fill colors as white, or I can make them as no color. No fill. And here also no fill. I just want the mid ones. Now, but I want the data labels to be added for the lower ones and the bigger ones. So I'll just go to add data labels. And I will change the orientation of the data labels to the right hand side, inside end. And I will add data labels here as well. Okay. Now you see everything is very congested in terms here. So I'll just change this and I'll format the axis. I want the minimum to be something like 150. And maximum, I think 3 lakhs suffice. This is, I think, now we can adjust the width of the chart and have it here. Then we can adjust the formatting and the color scheme and everything. This is how a football feed analysis is prepared. Okay. Any questions? Now, once you have prepared the valuation model, you might sometime have to go with the valuation report as well. So valuation report generally is prepared on a PowerPoint wherein there are different sections. The first section could be about the investment bank that is preparing the report, because they need to tell how much credentials they have and how much their report is going to be valuable. Then you go with the company profile. So whatever is the subject company, their management, their overview, headquarters, founded year, employee size, product and service offering, financials, revenue segmentation, whatever information that you can gauge, you will put in there. Then you will go with the industry. So is the industry growing? What are the market sizing? What are the trends? What are the headwinds and tailwinds? You will mention all of that. Then you will come to the economic overview. How is the employment in the entire economy, inflation, GDP growth rate, and all that stuff. Because the comprehensive report will have an EIC analysis, that is economic, industry, and company analysis. Once all of this is done, then you will give an overview of all the valuation approaches that you have taken and why you have taken them. You will write the commentary, then you will write, this is our recommended valuation number. Then once all of this is done, you will add the snapshots from this model into a valuation report, that this is the financial statement, this is the valuation summary, this is X, Y, and Z. All the snaps will go from the valuation model to the valuation report. This is how you generally prepare a valuation report. Now, one last thing for today, and then we are done. So we noted how to get to the enterprise value. Then we can subtract the net debt. That basically means we subtract the debt and add the cash. We will get to the equity value. Sometimes you will be required to calculate the price per share. So you can simply divide this equity value by the number of shares outstanding. In the WACC, we noted cost of equity. In cost of equity, we talked about the risk-free rate, beta, equity risk premium, company-specific risk premium, country risk premium, size risk premium. There are two discounts that you can levy on the price per share. That is not levied in terms of the enterprise value, but that is levied in terms of the equity value whenever you are buying a minority stake. So there are two discounts. One is called DLOM and the other one is DLOC. DLOM stands for discount for lack of marketability, and DLOC stands for discount for lack of control. So if you are buying a company's minority stake, then you will not have the powers to influence the decisions of the company. You will have a very less share. Your decisions might be overpowered by someone who has a majority stake. So you would be willing to pay less amount for that company's shares. And that is the discount that you will levy, and it's called DLOM. The other one is DLOM. DLOM is basically the discount that you will levy because the market shares, the shares of the company might not be marketable. You might not be able to sell them in the market very frequently. If it's a private company, you cannot sell the shares. If it's a public company, it is more liquid and marketable. So then that is the reason generally the private companies have a DLOM. This reduces their value further. Now, what is the difference between liquidity and marketability? That is a question. So marketability basically means how quickly and conveniently you can buy and sell the shares. But liquidity means how conveniently and quickly you can buy and sell the shares without loss in value. So I can buy and sell, I can maybe sell my house in 5 minutes, but I will not get the best deal in the 5 minutes. I might have to sell it at a very reduced rate. Then this house might be marketable for me in terms of the sale, but it is not definitely a liquid asset because I will have to lose certain value. So marketability means convenience and quick selling and buying, whereas liquidity means convenience and quick selling and buying plus without any loss in value. Okay. Now there are some terminologies that you should be aware of. FY stands for fiscal year. It is different for every country. Like India follows April to March, US follows Jan to December. So it is different. Then CY is calendar year. It is always the same. The Georgian calendar, 1st January to 31st December. Then you might have heard me saying a lot of time LTM and TTM. So LTM basically stands for last 12 months and TTM basically stands for trailing 12 months. So for example, if we are sitting right now in February 24, so the last 12 months means ending on the January 24 and starting from February 23. So this period is the LTM, the last 12 months. It might not be the end of the fiscal year or calendar year, but it has to be the end of any period. That is the last 12 months. Then the NTM means the next 12 months. Similarly, whatever other 12 months next. Now, let's say we are talking about the January to December thing, fiscal year. Now, if we are, let's say, sitting on 31st July, we are evaluating the performance. So from 1st Jan to 31st July, it will be called YTD. It is the year to date. That means the period of the year that has passed, that is past. And whatever is the remaining, that is 1st August to 31st December, it is called YTG, year to go. Similarly, there is MTD and QTD for month and quarter, MTG and QTG for the portion of the month and quarter in terms of the date. And YTD plus YTG is obviously FY, because this is past, this is future, and combined is the combined is the total fiscal year. One last thing is, if we are sitting here, then the period, the 12 months from here to here are LTM, or we can say TTM, and the 12 months prior to that are called PTM, the past 12 months. So the 12 months preceding the LTM is PTM, and 12 months after this is NTM, and this could be the, let's say, this could be the fiscal year, and this is then YTD, and this is YTG. That's it. Any questions? If you don't have a question, may I request for a thumbs up in the group chat? Okay, Tavleen. Others? Question or a thumbs up? Okay, Mitakshi. Chris and Dheeraj? So, Tavleen, I'm saying that if this is the timeline and you are sitting here and the current fiscal year is from here till here, this is the present, then whatever period has passed, it is YTD, and whatever period is remaining, it is YTG. And from the current date for the last 12 months, it is LTM. From the current date till the next 12 months, it is NTM. And from this point, then again, last 12 months, it is PTM. So this is 12 month, 12 month, 12 month. This entire is also 12 months. And if it is, let's say, 7 months, then this is 5 months. Okay, Tavleen? Awesome. Then build your valuation model for Colgate and take 2 weeks time. We'll have a doubt session on the weekend of what is the, like, 14 days from now, 24 and 25th. So I'll arrange for a doubt session wherein you can talk about all the doubts of your case study. Okay. Thank you guys. Have a great Sunday and see you. And all your academic sessions are complete except Python, that we will do later. Okay, thank you. Bye-bye.
Sir, one doubt.
Yeah, Tavleen. Speak.
Sir, I'm getting one thing tough. We get to know this like practically and theoretically, but to put it in the Excel, like it's getting difficult, like from where to get the data and everything.
Okay, so when you go through the book now, there are links provided in terms of the sources. And also when you go through the reference templates that are available on LMS, every cell has a comment from where this information is sourced. So all the sources are provided there. You need to practice that and you will be able to source everything.
Yes, sir. Okay.
Okay.
Okay. Thank you.
Thank you. Bye-bye.
Bye-bye.